2025 is going to be the year of show me.
So what are the 3 trades that you need to buy or at least keep in mind as we head into 2025?
What we've seen in the past 12 months has been this incredibly rapid transition, and I think that's going to continue and in fact accelerate in 2025.
So it's not just, okay, I want to get out of tech and buy the other stuff, buy industrials, buy banks, perhaps even buy some of the healthcare stuff. But to me, it's more about tech and complementing with some of the other sectors.
Let's start right there with the role of Mag 7. As we look ahead to 2025, what's your assessment just in terms of how investors should be thinking about how critical it is for the market's continued rally?
But our next guest says the real catalyst for stocks in the new year will be tax cuts.
Our next guest sees buying opportunities in the energy sector.
Our next guest has 3 market themes that you need to be watching for 2025.
Finally, we have a bear. Someone said stocks are going to fall, right?
We got some notes from you saying this is you're focusing on the year of the snake and what that might mean or may not mean for stocks. Break this down for us.
You had a lot of themes that you were looking at here, a dozen of them. We wanted to sort of drill down on a few.
The question is it being valued reasonably fairly, or is it just really at levels that are going to take a very long time? It's going to take a very long time to grow into.
Can it be another year with a Mag 7, some of these really big cap tech stocks with premium valuation? Do you think they can put in another year like they put in this year?
What's going to happen next year? Well, we still think we have a dovish Fed, right? We still are looking at record earnings. We're still looking at the strongest profit margins this cycle. Yes, the third year of a new bull market tends to be a little bit choppier, so that's one thing that kind of can restrain us a little bit here. But I love that right before I came on, you guys talked about market breadth, and I know I've come on for a while saying expect more participation. That's what we've been seeing. 2 weeks ago, 10 out of 11 groups outperformed the S&P. Last week, 8 out of 11 groups outperformed the S&P 500. We've got small cap leadership. We've got mid cap leadership. We think next year a big theme again is that overall a lot of participation. We've been neutral tech all year. People didn't like that earlier in the year, but now it's not like we hate tech. Neutral, people hear neutral. Oh, that means they're bearish. No, we've got a lot of tech exposure in the money we run. We just aren't going overweight because again, there are some valuation issues. There are potentially a lot of high bar when it comes to technology. So we just think some of these other areas look really, really good, specifically small and mid and those cyclical areas, which have been leading, really the second half of this year.
And Ryan, that's a really good reminder for people, by the way. When you say neutral, it means you hold it the same way to the market. You're not necessarily buying, not necessarily selling to get that all out of whack. What could go wrong with all of this? What's the biggest risk right now?
Yeah, I guess I'll go with 2. Valuations are stretched. Now, honestly, 12 months ago, people were talking about valuation stretched. That just means the bar is a little higher. But the one that gets me more than anything, the strength in the U.S. dollar. Normally, when the dollar's strong, to have a risk-off scenario. We've got a strong dollar since the election. Now, I'll tell you what, I think a lot of people are talking about this stronger dollar. A lot of people are talking about higher yields. That inner contrarian in me thinks those are going to come back down. But if the U.S. dollar continues to strengthen, that could kind of upset the apple cart. And look at what happened just the last 2 weeks, right? International markets haven't done very well because dollar's been strong. U.S. markets done just fine. I'm honestly surprised how strong U.S. markets have done with the dollar strength we've seen. But the dollar continues to be pretty strong here. That could be one thing here that can upset the apple cart, as they say.
Your 2025 target there, Lori, 6,600. That's your base case. Walk us through the math, Lori. How do you get there?
Sure. So thanks for having me. And look, we take a quantitative approach to the targets. We basically have 5 different sets of models looking at things like the economy, sentiment. We have a valuation and earnings test. We have a cross-asset test that looks at an earnings yield gap. And we also do some political analysis. And so some of the things that we've baked into the base case are, the typical performance when Republicans control everything. That's a gain of about 11%. Our cross-asset model, it's getting close to a point where it won't be favorable for stocks anymore, but right now it's still within a range that points to pretty healthy gains over the next 12 months. That gets us to slightly above 6,700 at the end of next year if we sort of take the pre-Thanksgiving close in the market as the starting point. Our valuation and earnings test is the least constructive. It's pointing to a PE at the end of next year on a trailing basis of around 22.7 times, but only gets us to around like 6,200 or so. I could go on and on about all the different models, but basically we run through the math on each of them and we take the median, and that gets us to around 6,600 for next year. And I will say this is the current path we see equities on. As the starting point changes at the end of the year for some of these models, we will update. As we get new information, we will update, but that's the path that we see us on right now. We do think, though, that you could have a 5 to 10% drawdown at some point, but we could still get to that 6,600 at the end of the year.
Lori, it's Julie here. It's good to see you. I thought it was interesting, the point you just made, which you made in your note as well, which is, that you're going to revise, that you're going to, things change throughout the course of the year. And when you talked about that, you also talked about it with regard to economic data, acknowledging that there were few people who saw the path of the economy, how it ended up this year. Most people were underestimating that. Is that sort of now baked in? In other words, do you think most of the time people are still going to underestimate, or has there been that sort of correction?
So what we've seen generally post-COVID, and the exception is 2022 when we sort of had the recession near miss, but generally what we've seen is that whether you're looking on sort of a quarterly basis or the annual forecasts, that GDP forecasts have started out too low and are constantly being revised up higher. That's the complete opposite of what we saw in the post-GFC world, kind of post-GFC pre-COVID, where GDP forecasts were constantly overestimated and had to be pulled down. I think that people, frankly, are still stuck in that post-GFC pre-COVID world. I've been around in the business since 2000, but I feel like a little bit of a dinosaur, but I know a lot of people who are making big decisions these days who came in around 2008, 2009. And so I think there is a risk that sort of your formative years in the industry can cause you to sort of overcorrect for the problem that you encountered early on in your career. I certainly had that problem with tech stocks. At certain points in my career, I came in the middle of the tech bubble implosion. So I think we are still probably stuck in this mentality for a while in which we are underestimating the economy going forward. And I had to make a decision, Julie, like the consensus forecast is 2% for next year. If you look at the sell side, now a lot of those data points are stale from pre-election, but there's a big difference in my work. If you're in a 1 to 2% GDP range, that's I think you've only been up 40% of the time when that's happened in the stock market. It's a pretty weak environment. And if you look in that sort of 2 to 3% GDP environment, you're up about 70% of the time with plus 10%. I think it's like 11% type annual average returns. And so I had to guess, which way do I think this is going to go? I think given that history recently of underestimating and the fact that GDP forecasts for next year are creeping up very, very, very slowly, I'm making a bet on the 2 to 3% instead of the 1 to 2.
And Lori, you talked about the economic backdrop. Let's talk about the political backdrop as well, because you told your clients, listen, you see, tailwinds, but also possible headwinds for the market in the year ahead. What did you mean by that, Lori?
So this really goes back to a pre-election survey that we did with our analysts, if we're thinking about that, sort of political backdrop. And so we asked our analysts, what's the outlook under different scenarios, Republican sweep, Democratic sweep, yada, 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 and we asked them to sort of, not just tell us, is this good or bad for your industry outlook if this thing happens, but why? We wanted them to tie it to policy. And the policy part of that survey was so fascinating because we had a lot of analysts who came back with kind of weak scores or mixed views. And the thing they told us generally was the tariffs are bad. Things like tax cut and deregulation, if we get them, are very good. And so there were some clear positives and some clear negatives. We saw a lot of people involved in the industrial complex, for example, also had serious concerns about what's happening with IRA spending. A lot of those came from outside of the U.S., but did still filter into the overall outlooks. And so I think that, we've gotten past election uncertainty. There is still a lot of policy uncertainty with some things that are clearly going to be excitable or make market participants excited. And there are some things like tariffs that could potentially be a problem. And the truth of the matter is we just don't know right now exactly how all of that is going to shake out.
We don't, Lori. In your note, as you always do, you talk about a more bullish case and a more bearish case. The number we talk about, 600, is your base case. On the bear case side, where you're at 57.75, what is the biggest risk? Is it a fiscal policy risk like that, something out of Washington, or is there something else you're watching from that could trigger that more bear case?
So, I think in my base case, we're assuming that there are going to be good vibes in the new year. We got an earful from companies this year talking about how things were frozen, whether it was businesses or consumers, because of the election uncertainty. So we assume that's going to unfreeze and give us some tailwinds. But maybe we'll be wrong from that. Right. There's certainly been some survey data out there suggesting that there really wasn't all this freezing that companies were talking about. So I think the economic thing is one thing to look at. Also on the economy, are interest rates perhaps starting to pinch in a way we're not seeing in the data yet? I've seen some hints on the corporate side that might be starting to happen. So those are some things we're going to have to watch. I would say, though, generally, regardless of what, might trigger a bear case, valuations are looking pretty frothy. If you look at sort of a median PE on S&P 500 equal weighted, it's getting close to past highs. It's got a little room to run, but not a ton. If you look at sentiment data, AAII net bulls was giving you a warning signal back in October. That feeds into our bear case. And CFTC data, while we don't sort of factor that in specifically to the targeting process, you're hitting new highs on U.S. equity futures positioning. Guess when the last time was we did this? January of 2018, right before we had a pretty tough year in the equity market. So I would say those things make us vulnerable to bad news if it comes. What could some of that bad news be? I do worry a little bit that some of the assumptions about corporate tax cuts that are coming are overly optimistic. I have heard references in some of the Trump speeches that I watched where he was talking about 15% if you're a domestic producer. I hear a lot of people just saying, hey, 15% for everybody. Let's bake that into our earnings forecasts. That doesn't seem quite right to me. So maybe there's some disappointment there. And then I think, again, I think most people are assuming that, they hope tariffs aren't happening. They think they're not modeling them in the same way I'm not in my base case. But I think you can look at the market performance in 2018 when we had the China trade war and we were down more than 6% for the year and 20% peak to trough as an example of what, some policy hiccups could do. Admittedly, we had Fed problems back then, concerns over QT, concerns that the Fed had hiked too much and that was going to tighten us into a recession. So those things, I think, had a bigger impact than the tariffs. But we're also kind of peering into next year, right, where it seems like maybe Fed cut assumptions are a little bit too optimistic. So we've got to watch that Fed messaging as well.
What are the 3 trades that you need to buy or at least keep in mind as we head into 2025? We want to bring in Kim Forrest, Bokeh Capital Partners founder and chief investment officer. It's great to have you here, Kim. So let's talk about what some of those trades are. How should investors be thinking about repositioning their portfolio as we head into the new year?
Sure. Well, I would look at that super semiconductor space and make some adjustments. Maybe if it's a taxable account, waiting until next year if you want to pay taxes on next year. I'm a very tax sensitive sort of manager. But seriously, it feels like semiconductors that are targeted on AI seem very overweight, and you should take a look at that. I think the small caps, and by that I mean companies that have a market capitalization of $1 billion or more. The super small caps, I never tread into there. It's not very liquid, and there's lots of reasons why I don't like really small companies. But those mid-sized companies are kind of forgotten recently, and they're also misunderstood. A lot of the lore on Wall Street says that mid-cap companies and small-cap companies mostly serve their where they are founded in the U.S. And I disagree with that. I think a lot of the mid-cap are global companies, but they're niche companies serving their customers well in one specific area, although globally. And I think those are the ones that you should be on the lookout for.
As you think out to 2025, of course, the mind naturally goes to what we've seen really permeate throughout social media, which is the threat of potential tariffs, and President-elect Trump talking about those and how that will be leveraged either as a negotiating tactic or to make sure that there's safeguarding of U.S. assets one way or another. Investors have to think about that. What is your playbook for tariffs?
Sure. Well, I think the obvious large retailers, that really depend on imports from China in particular. China seems to be probably the biggest place where tariffs are going to be increased, either in volume or in the, actual number or, the percentage. So I think China is an area of caution, and it has been for a while. So I think that's one area. But I think what we've seen in the last week, especially with Canada and Mexico, that it feels like tariffs are largely going to be used as the bargaining chip to get countries to change their behavior towards the U.S. And so I think that's how you have to look at your portfolio, stock by stock, area by area, and make an educated guess.
Kim, what about the AI trade? Is that going to continue to work? Are there signs of a bubble? What is your read just on where things stand?
Well, your last segment had, super micro, which I don't know. Nobody knows what the truth is, right? Hindenburg had some good points. It's always an issue if your auditor bails on you. This is a really big issue. And even though the company came out today and said, you know, a third party has looked at certain areas and they're not seeing the same thing that the auditor did, I've never in my 25 years been wrong about following the auditor. So pay special attention to Supermicro because of that. But it does feel like companies that have benefited may not be the beneficiaries forever and ever. And I think that, there is some bubble activity there. I know whenever I use OpenAI, it's kind of like using a bad intern. I really have to examine what comes back to make sure that, everything I've asked for is actually true. So there's still things to be worked out. And this technology always takes longer to develop than investors want.
Kim, just lastly, while we have you here, as you think about diversification in your portfolio, are we at a point where that diversification also includes cryptocurrency?
I'm really hesitant on crypto. And it's one area, I've been wrong, but it really does to me feel like gambling. We'll pick on Bitcoin. Bitcoin isn't used really for transactions. Bitcoin goes up and down based on a lot of things, but it feels like whenever China is tamping down on its currency controls, crypto sort of goes up then. I'd pay attention to that. And my thought is, until I can pay taxes in whatever crypto coin is out there, it's not real money. So I just take a real hard look at that and understand what you're getting into when you're buying crypto.
There is a new Wall Street high for the end-year target for the S&P 500 for 2025. Yahoo Finance's Josh Schaefer, is joining us now with more.
A James Bond joke.
Yes,
Julie. So the new target, the highest on Wall Street, is 7,007. 7,007. That coming from Wells Fargo's Chris Harvey. And really, Chris laying out a pretty similar case to the other bullish calls that we've been tracking, guys, in terms of year-end outlooks. That's about a 16% increase from where the S&P 500 is right now. And sort of the key quote in here is talking about a Fed easing cycle, right? We're talking about a Fed easing cycle. You guys were just talking about perhaps a Trump administration that could be a little bit pro-business, right? A lot of strategists highlighting that. And then the overall earnings picture here. The overall earnings picture expected to be strong. Going into next year, earnings expected to grow, margins expected to grow. Key part to this call, which is not dissimilar again to some of the other calls, more broadening of that rally. So Chris specifically highlights he likes the S&P 500 equal weight, which would move more in the broadening of the rally rather than the S&P 500 market weight, the one we talk about a lot, actually SPC, that gets carried up by big names like NVIDIA. So him highlighting perhaps more rotation in the market to come in 2025.
Well, and you said he's the highest out there, but where are we seeing them sort of cluster, right? It's like sort of 65, 6,600?
65, 6,600, which is about...
high single digits?
I was going to say, depending on where we're at in the S&P 500 on a given day, it's about high single digits. It's also about the average annual return of the S&P 500 in any given year, which is normally kind of where these targets lie. But I think notable from this, we haven't really had a bear yet. The lowest call is 6,400. I believe that's from UBS. And Chris Harvey from Wells Fargo wrote in this note, I wanted to be bearish. That's not an exact quote, but he said he wanted to be contrarian. And then he looked at the data and he simply couldn't really find a reason why. And I found that kind of entertaining,
Maybe
right?
That's concerning.
Well, I think what he said, and this was something you were just talking about, Josh, with sentiment that's getting more and more bullish. You have positioning that's bullish, right? There's a million indicators. Valuations are high. There are a million sort of those reasons we could think.
Well, valuation, 11 months I've heard about valuation.
Right, and think it's coming, right? But then when you look at the data, the thing with something like valuation, high valuations are a problem when something goes wrong, right? And my earnings projections are going to fall. Right now, when you look at something like the economy and what people are looking at in the labor market, there isn't a flashing red sign for people to then say, this is when valuations are going to become a problem. That's when your unwind happens. And so in the current state of play, perhaps the biggest risk that people are highlighting is inflation. We've had flat inflation prints for a couple months now, and I think the question is, do those get better going into 2025? Or are we looking at less Fed rate cuts?
Well, right, and that's something that Jeff Kleintop was just talking about, that is a potential risk for the market, that we're still pricing in too many cuts.
What if we get no cuts?
What if we get no cuts, Josh Schaefer?
Deutsche Bank's call. It's out there, Julie. People are talking about it.
Yeah, I know. Well, we'll see what happens.
We'll see.
Let's look ahead. Yeah. Going into 2025, and I'm hard pressed to think of a theme investors were more excited about than AI. I am curious how you think, as we head into this new year, how do you see that technology developing from here?
Yeah, Josh, what we've seen in the past 12 months has been this incredibly rapid transition, and I think that's going to continue and, in fact, accelerate in 2025. And that's actually going to lead to, I think, a lot of different changes. We're going to see things that we think are really big or were really big this past year, maybe not be so big next year, and yet other new things become really big and important. So fundamentally, I think we're going to see, for example, this notion of what I call hybrid AI. The idea that I'm going to do some of my computing, some of my Gen AI stuff in the cloud, but I'm going to do some of it inside a corporate data center, and I'm going to do some of it on a PC or smartphone device. And just the way we saw hybrid cloud computing, hybrid AI, I think, starts to change the story when we think about who are going to be the important players, where does some of this computing work get done, who are the software providers, how do they make companies better able to build applications that they in turn can use to change their whole foundation of how they work. Because that's where we are right now. We're just starting to see these big companies start to deploy Gen AI applications. I just finished a survey of about 1,000 US companies, and on average, they're using 6 different Gen AI applications. Now, some of them are POC, but 90% of these companies that I surveyed were already using one Gen AI app in production already. Next year, we're just going to see that grow. And alongside that, we're going to see the big cloud guys. I just came from AWS reInvent in Vegas. They made a whole bunch of announcements. I was just at Microsoft Ignite 2 weeks before that. They, of course, had a whole bunch of stuff around Azure and Gen AI. Google's got things going on as well. So we've got a lot of big players, a lot of big parts moving. Obviously, OpenAI continues to be a lead on the foundation model side, but where that Gen AI work is happening, again, I think is going to evolve, and there are some important implications there. Other thing is silicon. We're going to see more and more custom silicon. Of course, NVIDIA is going to continue, I think, to dominate, to be clear, and we'll get to more of that later. But, we just saw Amazon introduced a new chip called Trainium 2 that they believe could be a competitor, a lower cost competitor to NVIDIA. Doesn't mean they're not going to continue to use NVIDIA. Of course they are, but it's an option. Microsoft has been doing the same thing, same with Google. So we're seeing a lot more diversity in terms of the silicon that's being used to power this stuff. We're seeing a lot more software. And back to NVIDIA, just to follow up on that point,
because I named that clearly, investors decide, listen, that is the face of this AI revolution, right? It's Jensen Huang and his team had an incredible year. What do you see? How does NVIDIA's business, I guess, evolve from here next year?
So, first of all, they're going to continue to crank out GPUs in as fast as they possibly can, and the orders are going to be as big as they can possibly be, because we're still building up the capacity that people need. Now, there will come a point, it's not going to be in 2025, maybe it's 26, 27, when, as the way some of the stuff gets calculated and performed, maybe we shift to see where some of these things are done, and some of that starts to moderate. But we're still a little bit of ways away from there. But I think the important thing to think about with NVIDIA is the software story. So what they have been doing, they have these NIMs and other software tools that they've been developing and making available. So for a number of the companies like your HPEs, your Dells, your Lenovos, your Ciscos, the companies that sell servers to enterprises and businesses, they're saying, yeah, you can have our GPUs, and oh, by the way, just make sure you bundle our software with it, from which they can start making licensing money. And so I think you're going to start to see a software licensing business start to come into NVIDIA as well. And initially it's going to be small, but still that gives them a nice growth opportunity. And also, if we would ever see a slowdown, again, a couple years out, it shields them a little bit from that, because all of a sudden they'll have software revenues as well. So I think, Jensen's a very smart guy. He's going to be playing a lot of different cards in that regard. And of course, related to that, another trend next year is AI PCs and
AI-enabled PCs. Do you think AI-enabled PCs sort of jumpstarts a meaningful refresh cycle? Is that a 25 event, 26 event?
It's a 25 and into 26 event. And just to finish the NVIDIA story, rumors and rumblings are they may be jumping into this space as well sometime next year. So that's yet another angle on NVIDIA. But yes, I do think we're going to see, because you've got several things. When I talked with you last time about happening in the PC market, you've got the Windows 11 refresh, you've got the Windows 10 end of support, you've got all these AI PCs coming out there, you've got silicon from all the major players, and a lot of companies are sitting on 4-plus-year-old PCs that they updated at the beginning of the pandemic. It's time for a refresh anyway. So I think that's another story to watch in 2025.
It's a lot of tailwinds. Bob, we'll have you back next year, talk about 26 as well.
Sounds good.
Thank you, sir. Great to see you.
Yeah, you too. Thanks.
What will you be looking at heading into 2025 to really get a pulse on the state of inflation and the impact that will have on markets?
Yeah, I would look at things like super core inflation. Now, super core is, of course, the Fed's preferred measure of underlying inflation. It's sort of the most narrow definition of underlying inflation. That, however, is more likely going to decline in the first half of next year, particularly the first 4 months, mostly because we had these incredibly high readings in the first 4 months this year. So therefore, it's more likely base effects, things like vehicle insurance, that the resetting of that is not going to be as dramatically high as it's been in 2024 and also last year. That would bring super core inflation down. That actually is, again, another bullish factor for the next couple of months. I would say towards H2, when we're looking at a couple of other base effects that actually then would be driving inflation a little bit higher. And I would particularly point out inflation expectations at the front end. So short-term inflation expectation. I think about 2-3 months ago, I would have been much, much more worried about inflation because those short-dated, those short-term inflation expectations were significantly below 2%. They were already at 1.6, 1.7%. But what we've seen in the last 3 months is they've clearly gone up. They've gone up significantly to almost 3%. So at the moment, I actually do see inflation risks more on the downside for the next couple of months. H2, right, the second half might be bringing a bit more on the surprise side, perhaps on the hawkish side, but that is nothing which we should be particularly worried about right now, I think.
So Max, what does that mean for your outlook for the first half of next year for the S&P? How much more room do we have to run, if you can put a number on that for us?
Yeah, I think like the next 6-7 months, I think you can easily have 5-10% up. I think it's really, really supportive for equities. I think for global equities, we're really seeing sort of about 12 to 13% more upside in the next 12 months, so until the end of 2025. I think a lot of that could be front-loaded in the first half of next year, but I don't think it's just going to be the S&P. Within the S&P, I think there is really a basis for some of those sectors like industrials, a bit of like a mini re-acceleration there, but still liking tech here. I don't think it's just going to stop at the S&P, though. I think that Goldilocks backdrop with better growth, better earnings, re-accelerating growth, certainly against growth expectations and consensus expectations, that could be benefiting also other asset classes. Still things like high yield credit, perhaps even things like emerging market assets in the first half.
You mentioned that you like tech, but it seems like as well that there's going to be a longevity test that's faced with regard to the AI trade. With that in mind, is there another sector that you think could outperform tech despite all the weighting that has been thrust towards technology thus far?
Yeah, I think, to be honest, in the next couple of months, I don't think it is, am I buying tech or am I buying all the other stuff? So I don't think it's like, do I buy Magnificent 7 or do I buy the equal weighted S&P? I think it's more about tech and some of the other stuff, which could be things like, the industrials. When we look at the S&P, I think particularly US banks look great here. It's the financials, but in particularly the banks with perhaps hopes around some deregulation, but also with rates coming down, with volatility coming down, with already, some signs of a new capital markets cycle starting. That should be really favoring US banks over European banks. So it's not just, okay, I want to get out of tech and buy the other stuff, buy industrials, buy banks, perhaps even buy some of the healthcare stuff. But to me, it's more about tech and complementing with some of the other sectors.
Business leaders across the materials and industrial space are here at Goldman's conference as the industry looks ahead to 2025 and the incoming Trump administration. From tariffs to various regulation changes that we are expecting to infrastructure, what could these policy changes mean here for this sector, I want to bring in Joe Ritchie. He is Goldman's co-head of U.S. Industrials and Materials Investment Research. Joe, it's great to have you. Thank you so much for making the time.
Shauna, great to see you again.
So there's lots to get into here. I know you've been very busy with the conversations that you've been having over the last 2 days. I'm curious just to get your assessment right now of the industrial space and whether or not maybe the worst that we have seen is that behind the sector.
Look, from a macro perspective, the reality is that the ISM has been down for 24 out of the last 25 months. So a lot of investors that are here today are looking to see that inflection, right? We've had multiple companies on stage the last 2 days. I'd say cautious optimism is where we're at today. We've had several companies say we're expecting better growth in 2025, but the reality is that they're not really seeing it in their businesses today. As we've spoken before, we're very bullish on what's happening from a U.S. manufacturing perspective here in the U.S. So it's only a matter of time before it happens, and we think it'll inflect at some point in 2025.
What is that manufacturing renaissance? Because it's something you and I talked about 17, 18 months ago. What does that phase look like here as we enter 2025, and how you see that playing out?
Yeah, so let me put some context around it. Historically, in the U.S., we've spent roughly around $70 to $80 billion a year in manufacturing investment. And right now, we're tracking projects that are greater than $1 billion, tracking to roughly $270 billion that have broken ground. If you've actually taken a look at what investment has looked like over the last few years, the reality is manufacturing investment has already started to tick up. So last year, it was somewhere between 190 to 200 billion. This year, we're looking at close to 230 to 240 billion. The important part for the companies that we look at, and these are the HVAC companies, the electrical companies that really do the guts of the facilities and then also sell into the factory floor. The reality is for those companies, they've yet to see the inflection in their orders. A lot of the investment today has been on structures, which benefits companies like concrete, steel, you'll see the aggregate names also benefit as well. So we think a lot of the goodness right now from the manufacturing perspective is on the come for the companies that we cover.
If we do see some of the tariff threats that have been put out here by the incoming Trump administration, are some of the companies within your coverage maybe better positioned, I would guess, than others, just given where they do have their manufacturing plants? And I guess of that, how big of an overhang is that, more broadly speaking?
Yeah, so it's obviously been super topical, given that we're only about a month removed from the election. The reality for a lot of our companies are insulated, and you go back to the last tariff cycle, they didn't really see a material impact to their P&L. You have some companies like Stanley Black & Decker, which is more a consumer-levered industrial, which has said they're already dealing with 25% tariffs, and they import roughly, call it 25 to 30% of their cost of goods sold is imported here into the U.S. from China. If we were to increase tariffs to 60%, that's roughly a $200 million cost hit to Stanley. And the reality is that they're going to try to change their supply chain in order to offset that. That'll take time, right? But the majority of our companies, pretty well insulated. You have some manufacturing that's happening in Mexico, but the reality is a lot of our companies are actually in pretty good shape.
What are you hearing just from CEOs and the various executives who are here today, those who do have exposure to this potential threat? Are they already moving on that? I mean, how are they navigating this uncertainty?
Yeah, I mean, it's so hard right now. They're having conversations with their channel partners to discuss what pricing could look like if under different types of scenarios. But the reality is until you have something that's a little bit more finite, it's tough to actually institute anything. So Stanley is a great example of that. They're having discussions with the Home Depots, the Lowe's of the world already. I would assume that it's probably easier for them to get pricing through this time around versus last time, just because we have a playbook for tariffs. It's not new. But until you actually know exactly what's going to come down the pipeline, it's really difficult to make any decisions longer term.
Joe, what's the sentiment from business leaders about the incoming Trump administration? Overall, do they view this as good for business? How should investors be thinking about that?
I mean, the stock market seriously is
they're excited about it.
Yeah, the market's certainly excited about it. I think. Look, I think the reality is a lot of the business leaders are measured. And so I had Honeywell here today as an example. We met with their DC team in late September. And the reality is that, they were well positioned on both sides of the aisle. I think a lot of our companies are like that. And so, sure, there's optimism. I'd say that the areas of the economy that are probably going to benefit a little bit more are some of the kind of like more traditional oil and gas type names. And so I had Flowserve here today. I think that they view the election as a net positive for them, even if there are increases in tariffs. But generally speaking, I think that the backdrop and the feeling regarding this new regime is fairly positive.
How do you see companies accelerating their growth? When we're trying to identify just the biggest catalyst within the sector, is it M&A? How do you see that strategy evolving?
So it's a combination of new product introductions, investing organically, and M&A. So the reality is the sector that I cover, this multi-industry sector, is a list of industrial conglomerates. And what you've seen happening over the course of the past decade is they've been deconglomerizing. And the companies that were faster to move with changing their portfolio and become much more focused companies have benefited in this upcycle from a growth perspective and having better margins as well. So what you're seeing is you're actually seeing a ton of portfolio movement. I mean, I had like roughly 20 companies here. I'd say the vast majority have made some sort of change over the past decade. And there are still big companies like Honeywell was here today, 3M was here today. There's some big companies that are doing things behind the scenes to try to become a lot more focused.
Joe, within your coverage, who do you think is best positioned heading into 2025?
Yeah, so at Goldman we have something called the conviction list. The name that I have on the conviction list is Parker Hannifin. They're great company, really well run. They're part of what I would call the new compounders. They're one of those companies that started making moves about a decade ago to really transform their business. 2/3 of their business is tied to industrial activity, and about 1/3 of their business is tied to aerospace and defense. And so they've been able to perform incredibly well, even at a time when the industrial markets haven't been a tailwind for them. So what we're expecting is at some point in 2025, their markets are going to inflect. That's going to be really, really good for their business. But I would also have to say, look, if you're levered to the power markets today, we've been in basically a structurally declining power cycle for the better part of the last 2 decades. And so companies like GE Vernova that produce heavy duty gas turbines, had a company here called Mirion today that's really levered to the nuclear industry. And you're in the first innings of a burgeoning cycle. Those are two companies to put on your radar screen.
And Joe, another company that's very popular with a lot of our viewers, you mentioned before the conversations with 3M's CEO. Clearly the market has been excited about the transition. We've seen that reflected in the stock price. How bullish are you looking ahead to 2025?
Yeah, so commented earlier when I had Bill on stage that I had to comment on his enthusiasm. He was full of energy. He said it was the coffee. I think it was much more than that. They're truly transforming that company. Mm-hmm. Now this is going to be a multi-year journey, but it seems like there is a lot that he can do to really transform the margins of the business. Mm-hmm. And then ultimately, they can become a much more focused company as well. They've already started doing some divestitures. They divested their healthcare business, Solventum, last year. You're likely to see more from them in the future on that front. And look, he's got a new leadership team in place. So every leader that was up there today has, outside of Bill's been there for a little over 7 months. Mm-hmm. CFO just started 3 months ago, and we have a new IR person that was announced yesterday. So they're doing a lot within the organization to change the culture. And I think this is going to be a multi-year transformation for Bill and for 3M.
NASDAQ data shows dividends alone have accounted for almost 40% of stock market returns over the last 100 years. So definitely some data to back that up. But here are 3 top picks for high dividend stocks to check out from our Yahoo Finance watch list. First, you have diversified holding company Icahn Enterprises LP, that's the ticker IEP. You also have Zim Integrated Shipping Services Limited and metals and mining firm Vale SA. Now, keep in mind, these are names that most analysts see the biggest potential upside going into 2025. You'll also notice that most of these high-yield dividend picks that you see on lists, they don't tend to be from the flashiest sectors, but they are what consumers consistently need and what manufacturers produce. Think utilities, materials, health, and consumer staples as well, Ali.
So, Rochelle, how do you figure out which dividend-paying stocks are best or perhaps the most stable to invest in?
So there are some things to put on your checklist. Now, having a high yield can either signal an undervalued stock, in the case of Disney, where most analysts have a buy rating and they see some upside there, or it could be from a share price tumbling, which is a red flag as they're trying to sort of get investors to stay on board. So you have to really check the business fundamentals when it comes for this. So check for some of these declining revenues, profits, or market share as well. You also want to look for companies with a history of increasing dividends annually. That also signals stability and and growth. Now, these offer a more steady and predictable income, as you mentioned, not the sexiest of names, but they are steady for investors, and that can help outpace inflation and economic uncertainty. Especially keep in mind we have an incoming Trump administration that might shake things up in that regard. And a fun fact, I am a bit of a nerd, a dividend aristocrat or a dividend king is a company that's increased annual dividends consistently for at least 25 years. So look at the name American Waterworks. Now that holds the record with 70 consecutive dividend increases. So make sure you look out for some of those lesser known names as well, Ali.
Joining us now, Daniel Niles, Niles Investment Management founder and portfolio manager. Dan, it's good to see you here. With all the broadening talk, we did see tech lead gains last week, so the broadening sort of paused, if you will. But what do you think is going to happen next year? Are we going to continue to see the runs that we've been seeing?
Yeah, I think next year you're going to continue to see the broadening pattern. And if you look at it over a longer term basis, so if you look at the first half of this year, the S&P was up 14%. But that was really led by the Magnificent Seven stocks. The equal weighted S&P was up 4% during the first half of the year. Since June 30th, however, the S&P is up about 12, but the equal weighted S&P is also up about 12%. And the policies of the incoming administration, which is lower taxes, more deregulation, that should help a lot of the smaller mid-cap stocks and more stocks in the value space where the cost of money and regulation matters much more for them than a big behemoth where it really doesn't matter that much at all. And then the second part of it is I do think you're going to see a pause or a digestion phase in all this AI CapEx next year. And obviously a lot of the stocks that have powered the market this year are heavily focused on AI spend. And so if there is some slowdown in that, you could see a big issue in the tech space, and that could potentially affect the overall market as well.
You know, Dan, you mentioned Trump moving back into the White House, and what's interesting is how he thinks about big tech. I mean, last week when he announced his support for Gail Slater, Trump just went off on big tech, right? I mean, made a point of their stifling competition, they're running wild, and certainly J.D. Vance, no fan either. What they seem to be is more fans of little tech, for lack of a better way to put it. I'm just wondering, Dan, like as an investor, when you see those kind of headlines, how do you think about that? Do you think about that, or is it noise to you?
It's not noise because you always want to invest with tailwinds. And so if you know that the new administration is really more focused on helping the littler names, then that gives you a little bit of a tailwind if you go look at that. But from a bigger picture basis, Josh, I think it's more about the fact that you had a 60% increase from the biggest spenders, the Microsofts, Googles, Amazons, for AI CapEx this year. And next year, you could see that number slow to 10 to 20%. And a lot of companies, especially in the semiconductor side, aren't necessarily thinking that's going to be the case. But if you're not ending up with big returns on all of that investment, and think Microsoft, right? Microsoft reported the June quarter. They guided below the street for the September quarter for revenues. Then when they reported the September quarter, Microsoft guided below the street for the December quarter in revenues. And this is despite the fact that they have a 50% economic interest in OpenAI, which arguably started this whole AI buzz, which is the launch of ChatGPT at the end of 2022. And so that's the bigger thing to worry about for big cap tech next year, is if you go through this digestion phase, much like you went through after the initial surge of spending in COVID, and then you saw what happened with a lot of these stocks in 2022, that again would argue for more broadening to some of these other smaller names that have sort of been left behind in this big AI surge for the mega cap tech names.
Dan, then what are the implications of what you're discussing for the likes of NVIDIA, right? Are we going to continue to see that willingness to spend on their chips going into next year? And of course, that's not even to talk about a potential headwind of ratcheted up tensions with China. I mean, we just saw an example of that today with these reports that China is looking into antitrust concerns with the company.
It's a fantastic question. And this is the way I would think about it. And you saw this during COVID. When you don't have enough supply of chips to meet demand, all your customers come in and double and triple order. Then what happens is as soon as you can meet demand, those orders start to get canceled. And so with NVIDIA, they've talked about the fact that for the next 6 months, they believe that demand is exceeding their supply or ability to make those chips. But what I would say to you is I'm I feel strongly about this, that once they catch up, because you're not seeing these big upward revision in revenues for the likes of Microsoft, for example, but you're actually seeing downward revisions, you're going to see these companies come back by mid-year, these customers, and say, you know what, we're going to spend 20% more or 10 to 20% more on CapEx this year than the 60% increase we saw in 2024. And NVIDIA, if you look at their revenue forecast by Wall Street, NVIDIA doesn't put out forecasts a year out in advance, but Wall Street has NVIDIA's revenues up 50% in 2025, falling over 100% increase this year and the year before. And so I find it, at least from what I'm seeing today, hard to believe that they're going to be able to get to those forecasts. So you may see a nice move up in the stock in the beginning of this year, and then a big fall off in the middle of the year. And by the way, don't forget, during COVID, revenues went from up 84% year over year at the beginning of 2021 to down 20% by the end of 2022, and the stock went down over 60% in that move from peak to trough. And so that's an example of what carnage you could see going forward.
And now for today's strategy session, the S&P 500 on track for its best year since 2019 as the index continues to clinch record high after record high. But the market's biggest driver, the Mag 7, is showing some signs of pullback from its rapid growth. Joining us now, we want to bring in Jake Manoukian. He is at JPMorgan's Private Bank U.S. Head of Investment Strategy. Jake, let's start right there with the role of Mag 7. As we look ahead to 2025, what's your assessment just in terms of how investors should be thinking about how critical it is for the market's continued rally?
Yeah, I would say it's important but not critical, right? I mean, these companies they're the largest shares in the index. Index concentration is at all-time highs. But the good news for investors is that their profiles are very attractive, right? They have the widest cash flow margins in the market. They have the lowest amount of levels of debt, and they have secular drivers of revenue and earnings potential. So I think they're obviously important for the market, but they're not critical for the market's success. And we see signs that earnings growth is set to broaden out as we head into 2025. And I think after the election, a lot of people are willing to kind of look ahead. That psychological overhang is in the past, and they're looking for more opportunities in all different segments of the market.
Even with regard to the concentration that you were mentioning, how and where are the sectors or even names that are perhaps most primed to take on some of that share of concentration?
Yeah, I mean, the public markets aside, I think what's really interesting is happening in private markets, right? You guys were talking about deal making and some of the merger and acquisition activity that's happened. You know, Wall Street's been in this kind of ice age for the last 2 years in terms of deal activity. When you think about IPO issuance, high yield issuance, lev loan issuance, we've seen a collapse in activity given interest rate hikes, given fears of recession, given elevated inflation, and we've seen a nascent recovery, but I think given a shift in the regulatory environment, that's really going to change. So when you think about private equity exits, private equity deal flow, when you think about the opportunity that private managers have, I think it's compelling to us.
It sounds like opportunities across capital structure.
Yeah, across the capital structure too. I mean, if you think about all of the the debt financing and the mezzanine level financing that it takes to get these deals done, we expect more volume and more opportunity there. And when we think about that from a portfolio construction angle, we're very optimistic. There's a lot of ways for investors to get those kind of like high single digit, low double digit returns. Yeah. From a lot of places, whether it's large cap equities or whether it's private markets, whether it's mezzanine debt, whether it's direct lending, whether it's infrastructure, whether it's real estate. There's a lot of different levers that investors can pull to build a resilient portfolio that can still generate attractive returns.
So the way that I'm kind of thinking about it now is it sounds like it's who's financing the deals, which leans towards financials and the larger banks.
Yes.
And then on the other side, it could be small and mid caps that are most primed to be acquired, but you'd have to be really judicious
selective
about where you're picking those.
Exactly. I mean, a better deal-making environment should support multiples and valuations for the small and mid-cap spaces. But yes, the financial sector, the asset management industry broadly, those are two places in the public markets that should benefit.
But our next guest says the real catalyst for stocks in the new year will be tax cuts. Joining us now is Jay Hatfield, Infrastructure Capital Advisors CEO and CIO. Jay, always good to see you.
Thanks, Josh. Thanks, Jody. Great to be on.
So you raise your 2025 year-end target for the S&P. You go to 7,000, Jay, and that's after that red sweep we saw on election day. Walk us through why.
Well, it's really just arithmetic. So cutting corporate taxes is great for corporations. Not very insightful, but it's true. And it's also good for earnings growth of corporations because their growth is determined by their after-tax return on capital. So a lot of strategists come on and say, oh, well, I don't think earnings are going to grow 10%. Well, they normally grow 10% because if you retain 70% of your earnings invested at 15% after tax, that's 10. So it's built into the market, but if you lower that tax rate, then the growth rate goes up and earnings go up. And so if it weren't for a corporate tax cut, which we don't know yet, that bill is going to be problematic, we would just be in line with the street. The street's coming out 65, 6,600. That's where we would lower our target. So we'll be dynamic during the year like we were this year. We raised our target to 6,000 in June, which is working nearly perfectly. Even at the end of the year, it seems to be kind of coming back to 6,000.
So there is still the if around the tax cuts, though, right? So it seems as though most investors are assuming the existing tax cuts are at least going to get extended. We definitely have talked to some people who say, well, we don't know if we're going to get a cut beyond that. So how do you sort of game that out at this point?
Well, we originally had thought about a 7,500 target, so that's the 15% magical rate that gets thrown out there with some caveats, like you have to be a domestic company or something. But we think it's going to be difficult to get this bill passed. You know, it's reconciliation, which requires a balanced budget over 10 years, which you can play a lot of games with, but also this Congress, at least a portion of this Congress, is pretty worried about the deficit. So it's not going to be just an open book. So that is the big uncertainty of the year. And we think it's more important investors focus on that than tariffs or deportations or the latest nomination or other distractors. Just focus on this critical element, which is corporate taxes.
But you must get questions, I'm guessing, Jay, from clients when they ask you about tariffs. Well, are you in the camp that, listen, it's a negotiating tactic?
Well, that's part of it, but what everybody ignores, because this is a little bit of a talking point left over from the election, and a lot of the economists that are writing about this are Democrats, like Alan Blinder in the Journal. But what everybody ignores is you get proceeds from the tax. It's basically a partial VAT. So that's good for long-term growth and investment because you have a lower budget deficit or gives you firepower to cut corporate taxes. So it's actually, in the long run, a positive thing, and it doesn't really increase inflation from a technical perspective. Inflation is ongoing increases, which only really comes from the monetary sector, from increasing the money supply. It's a one-time hit, and that is going to show up a little bit in CPI, and it's not great for some consumers, to be fair. I'm not the biggest advocate of it, but I think everybody's missing that there's a long-term effect that's positive. Like if Trump came out and said we're going to have a 15% VAT and pay for a gigantic corporate tax credit and lower the deficit, that would be good. Of course, the prices would go up at one time, and people wouldn't be too happy about that, so it won't happen.
Let's talk about where you're looking right now, because I know one of the places you're looking is small caps, which sort of hasn't yet really been working, even though everybody keeps talking about it. And even earlier, you know, we talked to Torsten Slok of Apollo, who said the problem with small caps is that they are not profitable, or at least a large proportion of them is not profitable. And if the Fed doesn't continue to really cut rates, that gives them sort of a slimmer margin for error in reaching profitability.
That's definitely true. As a whole, small caps don't borrow more money. But when we think about small caps, we have our fund is ZCAP. We don't invest in any money-losing companies.
Gotcha.
And in fact, if I was going to say one thing to investors who are just starting to invest, just follow that rule. Because it's
don't invest in companies that are losing money.
Right. Like when I was an investment banker at Morgan Stanley, we wouldn't allow them to go public. It was sort of a better day of investment banking until they were profitable. It's a while ago, but it was better days. But because then you're as I mentioned, when you have profitable companies, you're stacking the deck in your favor because they invest their profits. When you don't, you're stacking it against you. And so, yes, I agree, the unprofitable portion of the small caps have not been doing well, but the best way to think about small caps are slightly cheaper value income stocks. They're a very low portion of tech. So you'll see, like when tech's doing well, small caps will be doing poorly and vice versa. And they tend to be correlated with our other funds, which are all income value funds. So we haven't done a great job of diversifying our preferred stock and other funds because they all trade together. Like they're all getting smashed today.
You also have, what you call some indirect AI plays. Now, AI plays, everybody always just immediately goes to NVIDIA. What are some indirect AI plays?
Well, the easiest one, because you don't even need the AI, is all the investment banks. We focus on Goldman Sachs and Morgan Stanley. They're the biggest. They're our biggest positions in ICAP, our large cap dividend fund. But not just because of the M&A. Although this is probably the biggest change in antitrust policy ever. Because essentially you had an antitrust enforcement policy was that you can't do mergers, and now the Trump administration is likely to be very loose. So that's great, of course, for those investment banks. But there are definitely going to be AI IPOs next year, and that's going to benefit these large investment banks because they almost always, particularly Goldman Sachs and Morgan Stanley, get the lead management role. And that's, I know from being a banker, that's where you really make money. You make like half of the spread. So being a co-manager, you don't make that much. So they're really likely to have a great year.
Jay, just quickly, because I know this is something, Josh, you've been watching closely. Some of the appointments that we've seen in the Trump administration, though, it's not necessarily given that they will be anything goes on antitrust and everything gets the rubber stamp, right? So how are you thinking about that?
Well, I just think that it was so extreme. Like
that any improvement would
right,
be an improvement?
you could just pick somebody on the street and they would be way better. And you can see that in Silicon Valley, which is my hometown. If you lose half of Silicon Valley to Trump, you've done something really wrong. And you think about their business, they're okay, oh yeah, we'll pay some more taxes, they'll dodge it through capital gains, we won't mention that. But if they can't sell their companies, they can't run their businesses. They need to get realizations. So they were extremely unhappy about that antitrust enforcement. So really anyone will be dramatically better if they're just middle of the road, which they're at least going to be. So we're not so concerned about that appointment, just getting rid of the last approach, because it was the most leftist antitrust policy we've ever had in history. So as long as that's gone, it's going to be dramatically better. And like I said, we're not just focused on that. These AI, nobody seems to focus on it, but it's going to be AI IPOs, there has to be.
What are those two scenarios that investors need to keep in mind as we look ahead to the new year?
Sure. I think that what we are seeing is that once the sugar rush is over, we think that there are going to be two phases. The first phase is going to be that there's going to be a wait and watch type of an approach where businesses and consumers will want to see how the new policies turn out, how the new tax rates turn out. So they're going to scale back, which will lead to a pullback in the market, in our opinion, in the first half of 2025. And then the second phase is going to be in the second half, where we'll get the trifecta effect: low rates, low taxes, less regulation. And that's going to be pro-growth, which is going to drive up equity markets.
How much of a pullback are you anticipating?
I think up to a 10% pullback could be
a correction, potentially.
Potentially a correction, yes, because we have gone up so much, and although the fundamentals are there to support it, but a pullback is definitely long overdue.
Just quickly here, there's so much buy on the dip mentality. If we were to see a pullback, what's to say that there wouldn't be enough entrance into the market to actually keep a correction from even happening?
Sure, that's definitely a possibility, and markets are expensive. If you look at the PE of S&P 500, we are trading at historically high levels, and that's not to say that we couldn't continue to trade at historically high level. It's very difficult to time it. I think some of that is going to come into play, especially with so much in money market funds, over $6 trillion. So we feel that we can't time it perfectly, but at some point we are going to get some type of a pullback in the markets.
And then talk to us a little bit more about that rebound that you briefly touched on. So you have that trifecta effect going into effect you see next year. Then what does that rebound look like? How can investors take advantage of that?
I think one of the problems that we are seeing right now is that everyone is so tech heavy right now. Even if you're investing in the S&P 500 index, you're more than 40% in tech. So I think investors really need to focus on reducing the risk in that portfolio so that once that pullback happens, they're not so heavily concentrated, and focus on other areas in the market going into 2025, which will benefit under the Trump administration. So we like financials, we like utilities, we like energy. I think those are sectors that investors should broaden their exposure to.
And so within that, which sector is the most ripe to really take on some of the share that the Mag 7 has really been able to see grow at least on a market cap basis over the course of this year as well, and within the S&P 500?
We really like the financials because, and that's playing out really well. I think there's legs to that because we feel that the Fed is going to stay the course. With this CPI data as well, we think they're going to cut. We think that the terminal rate will go to about 3.25 to 3.5. So banks will benefit from that greater investment banking activity. Also under Trump, we think there's going to be deregulation, which is going to help the banks. So for example, a name that we like, Goldman Sachs, they benefit from investment banking. Their assets under supervision in their wealth management and asset division is $3 trillion, more than that. So that's going to grow as the market goes higher, and that's recurring revenue for the company.
You mentioned energy too. When you see a bit of a bounce back, or what we're expecting to see here in crude, are you talking about the large oil players, or how, I guess, can investors best take advantage of that?
Sure. So we do like the large oil players because, again, sticking with that deregulation theme, I think that industry is going to benefit from that. There'll probably be more drilling projects that are going to happen. So we do like the ExxonMobils, the ConocoPhillips, which from a relative point of view are trading at relatively low valuations and also paying a very good dividend as well.
What does that mean for, and kind of more broadly looking out to some of the earnings growth expectations, what are your anticipations, especially if we were to have to move through a correction in order to see the markets hit some of the targets that the street is already setting forth for the end of 2025 here?
I think the earnings will continue to do well, especially I think the Mag 7, they will continue to perform. Mm-hmm. But like what we saw with Oracle right now, right? These are priced to perfection. So anything less than a stellar report will be led with a pullback in the market. So we think fundamentals are strong. We think the Fed is going to be accommodative. We think generally the economy is going to be in a good place, but nothing goes up in a straight line. So some type of retracement we should see.
All right, our next guest sees buying opportunities in the energy sector. We've got Cole Smead. He's the CEO of Smead Capital Management joining us. Cole, great to have you in studio. I want to start on OPEC holding off on that additional production. What do you anticipate that impact looking like next year? Is there any potential for a squeeze in the market?
A lot of the people that report on oil don't come from OPEC meetings. They come from Western journalism, and so therefore they're not sitting there in OPEC discussions talking about that. They're really on the outside of that. So I look at OPEC has been very communicative. They've said, hey, here's the deal, we're going to cut, and we're going to maintain. And everyone's like, we'll see. They're very worried about that. The reality is, if you look at OPEC, they haven't been the swing producer for 20 years. We are the swing producer here in the United States, and we've grown production massively looking back that 20 years. The question is, can we, as that marginal producer in the world, continue to sustain? That looks very unlikely. If you go, last week, Chevron was reporting that they're going to pull back $2 billion in CapEx. Well, why would Chevron be pulling back in $2 billion in CapEx if Donald Trump is saying drill, baby, drill? And the reality is because they're not going to waste money unless they get the prices to. And so we're really seeing this match of, there's worry about supply glut, but at the same time, places like the Permian, you're seeing a lot of well decline. And the question is, where will that meet? And I think because the stocks have lost money for 2 years, everyone's saying, great, it's tax loss selling season. If those stocks are going down, what is that telling us about the future? The reality is it's telling us nothing. It just tells us that people have lost money over the last year.
What does that tell us, though, from an investment? I guess, should investors be viewing this as an opportunity, just in terms of the fact that they are so cheap and they have been under pressure?
Yeah, wonderful question. So, let's just take the energy business. Let's compare that to the S&P 500, for example. Mm-hmm. Okay, so I think the S&P 500 produces like 18% return on equity. If you look at the average oil business right now, you can find businesses that produce somewhere between, say, low teens to maybe mid-teens return on equity. Okay, now the question would then be, well, what do I have to pay for those different return streams? You pay 4 times book or greater for the S&P 500, you're paying somewhere between book and book and a half in the energy business. So you're getting similar returns, but vastly different multiples for that. And I think that really shows you the opportunity in the business, which is that these businesses historically don't produce those returns because they drilled way too much, lost way too much money. That was the story of the 2010s. Now they're really disciplined. And everyone's freaked out. Back when they lost money, they loved those stocks. I don't get it. Mm-hmm. Today, they're producing these good returns with great balance sheets that they really have never had. And the market's really freaked out on that. I'll mention one other thing. If you look back at 2 other periods, the 70s, which was a terrible time to be a stock market investor, and then the 2000s, as noted by the S&P, it did terrible. Well, you made wonderful money in the energy business, and you didn't really care what went on in the S&P 500 outside that. So to your point, it's incredibly timely. If someone's waking up saying, I find what's going on in the S&P 500 to be very unattractive, I would agree. And the reality is that's a great place to go allocate capital and try to make money in what will be a tough equity environment. But geopolitical problems, do they help you or hurt you? They help you. A lack of supply in the oil business looking 10 years forward because we can't produce as much. Those problems help you, and there's not a lot of things that I can find that where I could say, hey, problems help you today.
So what's the trade then? Is it individual names? Is it an index that tracks the sector?
Yeah, I would say if you look at like the XLE, it's a pretty poor way to go do this because it's really holding the majors. So for example, we own APA, Apache is what they formerly were known as. They trade for less than the invested capital in the business, and those are producing about mid-teens returns. So how we look at this as an investor with names like that, Occidental Petroleum, Conoco, up north of the border, Cenovus, is what if in the long run, because these are capital-intensive businesses, they go to book value, which I know is like unattractive to say, but they're capital-intensive. All we're really anticipating is making the return stream, which I call cash, that we accrue and then ask, do we want to pay it in dividends or buybacks? If that happens, our multiples could go down on those businesses and we can make very good returns. That's a vastly different conversation than what if the S&P goes from 4 times book to 3 times book or 4 times book to 2 times book? Will 18% returns make up for that? That will be a lot tougher in comparison. So what are your expectations you have to build in to make money on securities? I think that's a big difference between those names I mentioned versus what you have to do broadly, or even in the XLE. You really got to know that Exxon and Chevron are going to do well in the XLE. And we don't got to know that, right? We just got to go out and find names that fit what we do.
Cool. What does that tell us as we just take a step back and kind of relay the investment thesis there to maybe what that tells us more broadly speaking about the market right now and current valuations and where things stand heading into the new year? You have a new Trump administration. What should the calculus or what should the approach or strategy, I guess is the best way to put this, be for investors heading into the year given where things are?
Yeah, it's a great question. First off, just in full disclosure, I'm a card-carrying Republican, but I'm also a card-carrying pragmatist and capitalist too. And I say that because everything of Trump, we're at peak Trump. When I say peak Trump, everything that can go right, it's already priced into securities markets. Oh, we're going to save money here and we're going to cut taxes to corporates and all that stuff. It's all priced in. It's completely priced in. Anything less than that's going to be disappointing. That's the first thing I'd say. Secondly, U.S. household ownership of equities has never been higher, as noted by the St. Louis Fed. Foreign ownership of U.S. equities has never been higher. Those bode terribly for forward returns. And so, someone said, I was joking about 75-degree weather in Phoenix, and they said, well, here we live in the real world. And I asked them, is this the real world? And the reality is I don't think it is. Everyone thinks they're going to get rich in the stock market. In comparison, a 10-year treasury paying you 4.2% against these risks looks very attractive. It's risk-free. You know the volatility. And most people are taking way too much risk on the stock market. So to your point, I think it's a wonderful time for people to say, wait, what if too much good things and hopes and dreams are baked in because we're all actually doing the same thing at the same time, which never bodes well for risk-taking. And again, the risk-free rate is staring you at a pretty good return relative to our lives, I would argue.
I think as we go into 25, I think you're starting to already see some signs that the economy is slowing. Look at manufacturing, look at some of the numbers in the employment area. And I think the Federal Reserve is going to be on pause for a little bit. Then they realize somewhere, late spring, that it's probably going to be time to start getting into this rate cutting program again.
Interesting. And so what is your forecast and your outlook for the number of cuts and how the markets would ultimately appreciate that or digest that, I should say?
So what I'd like to see for next year is another 1% in total cut. Now, do we get there? I think it depends on a lot. It depends on inflationary numbers. It depends on how the economy is doing. There are aspects of the economy that are doing well enough. I mean, Powell has come out and said that same thing. But whether or not it continues to hold up is the major question. There are questions about Trump's policies. Now, we all know Donald, especially us in New York. We know what he says doesn't always translate into exactly what happens. And so I think you have to take it with a bit of grain of salt. So does that mean interest rates continue to sort of trend up? I don't think so. I think, right now at 423 is probably a number that it should come down from. I think, if we can get to 405 or 4% on a 10-year treasury into early 25, that's actually a good thing. And then I think we could trend down a little bit further later in 25. But I think for the S&P 500, I have 6150 for year-end target this year.
Okay.
But then, because I think the economy is slowing and I think the Federal Reserve is going to be on hold, you're probably going to see a little bit of a give back. And so I could see 58.50, 58.25 by mid-year. But then again, I think as rate cuts come in, as the economy gets a little bit of a boost from these rate cuts, because not all of Trump's policies are going to be enacted, I see 7,000 for a year-end target for next year.
Interesting.
So from 7,000 to from 61.50, you're talking almost 14%. So a pretty decent year.
So, and that would be after not an all-out correction, it would seem, for the first half of the year in your outlook there, but an extreme bounce back even off of the pullback that you're anticipating.
Yeah.
What are some of the areas that could be heaviest hit in that initial pullback? And then on the back half of the year, if you will, the mullet trade, as we've heard it talked about in the past, where that could initiate even more interest from investors?
So what could get hit? I think pretty much all areas of the market are going to probably feel the pain under that, getting us to like 58.25 figure. So I wouldn't be freaked out in getting out of the market. I'd use that as actually a buying opportunity. And so what I would turn your question around and say, what areas of the market do I want to focus on? I want to focus on, I think, what's going to work. If we have a slowing economy, people generally try to grow the value of their portfolio. So how are you going to do that? So communication. So I'd look at things like Netflix and Google or Alphabet on any kind of pullback. In the consumer discretionary, I'd look at Amazon, and then I'd take a look at RCL, which is Royal Caribbean, has done extremely well, but I wouldn't be buying it here. I'd wait for a little bit of a pullback. Finance, I'd take a look at the money center banks. I don't think the regional banks are going to be sort of doing as well as they have done. They rely too much on demand growth, loan demand growth. So I think the money center banks, and I also would take a look at like an insurance agent like AJ Gallagher. In industrials, I take a look at something like United Rentals, which is getting hit today, but I don't think it's time necessarily to be buying that. If you want to do a little bit of buying into United Rentals now, I would say just add a little bit and wait for a little bit more of a pullback. I'd also take a look at Eaton, ETN, and then I'd take a look in the technology space. And so what I like in technology is Salesforce reported a great quarter, well, I guess a pretty good quarter, we could say. But very optimistic about their new products. And then I take a look at Arista Networks, ANET, which has done extremely well, demand for servers for the data center. So those are my areas of the market that I take a look at. I wouldn't be buying it now, but I think you have to make a list. Just like going to the grocery store, you have to be prepared as what to buy.
Right.
So that's what you need to do. You have to be prepared, you have to have a list, and you have to look for bargains when they come up.
Investors turning their focus to the new year. For that, our next guest has 3 market themes that you need to be watching for 2025. We want to bring in Jim Tierney. He's the Chief Investment Officer of Concentrated U.S. Growth at AllianceBernstein. Jim, it's great to have you here. And I think one of the first themes that we want to talk about, and it's clearly a focus here of investors as of late, is AI. How critical, how big of a theme is that going to be in the market next year?
Really has dominated the market this year, and I think it will dominate the market next year. But I look at this as a train ride, and the first stop on the train was the semiconductor companies, and they benefited greatly in 2024. The next stop is who are the implementers, the hyperscalers, the software companies that will benefit. And ultimately, the third stop is everyday companies, but that'll take a while to get to that point. So I'm looking at 2025 as the year of the software company, and how do they implement it, and how do they sell it?
What does that mean for the Magnificent Seven? Because we are seeing profit growth estimates slowing. They're still huge, but slowing for the Mag 7 names. Does that mean the way to play AI in 2025 might be looking outside of those top 7 companies?
I actually think some of the Mag 7 are perfectly positioned. They've spent a ton of money, more than $200 billion of CapEx this year, probably more next year, with not a lot of visible return yet. But the key word there is yet. I think in 2025, we'll start to see that ramp up. Microsoft is a great example. They have Copilot out there. The results so far have been a little bit disappointing for investors, and it's probably why the stock hasn't kept up with some of the other Mag 7 stocks. But as they sell more of it, as companies embrace it, I think Microsoft is really going to get a bid here, and people are going to get excited about Microsoft again.
One of the other themes, or your second theme, that caught our attention was power consumption. And maybe on the surface is not something that sounds too sexy for our viewers here, but it is very interesting just in terms of that opportunity and what you think investors need to be watching for. So tell us about that and why that is critical here in the new year.
Because of efficiencies, we haven't had any growth in power consumption for decades. And we're starting to get to the point where there will be growth. Reshoring is a big opportunity. Data centers use a whole lot of power. So not only do we need more generation, but we need more transmission and we need more storage. All of that, if you say, well, it only grows 2 or 3%, the spending that you have to do in today's dollars is massive. So I think that's going to be an underestimated long-term driver of economic growth in the U.S.
Is there a name in the space that you're looking at?
Eaton is a great way to play it in terms of whether it's generation, whether it's transmission, whether it's storage, whether it's data centers. They play in all of those, and it's a U.S.-based company. The majority of their U.S. sales are manufactured in the U.S., so if tariffs come to pass, I'm not really worried about Eaton.
You know, that's so interesting, Jim, because I was just at Goldman's Industrial Materials Conference last week, and Eaton obviously an outperformer within that space. So it sounds like you actually think there's a lot more runway for that growth. I guess, what does that growth look like?
Exactly. Everybody thinks this is a 1 or 2 year trend. This is going to be a 5, 10, 15-year trend, both in terms of reshoring and data center usage.
To that end, too, I'm interested in your take on the impact of tariffs. We've spoken with lots of guests who see it as a big headwind for the macro picture, as it could lead to inflationary pressures. But I know there's one name in particular that you see as a beneficiary of tariffs because of the currency impact it could have on the peso. Talk to me about that.
I think you have to be careful in terms of where the tariffs are. Are they a threat? Are they a reality? And the threatened tariffs with Mexico and Constellation Brands. Constellation Brands is a brewer of Mexican beer. They exported out of Mexico to the U.S. Will tariffs be implemented against Mexico? Who knows? But with the depreciation of the peso over the last few months, much of that has already been offset. And instead, you have a company that's trading at 16 times earnings, cheaper than it's been in years and years, with growth in the consumer staples space. It's a real consumer staples growth company, tariffs or no tariffs.
How big of a risk, though, is tariffs?
Oh, it's meaningful, and do you want to pay 20% more for your beer or whatever it might be? Of course you don't as a consumer. So you have to be careful about how they're implemented, but I think it's more a threat than reality.
The number of ETFs launched this year has risen 15%, and U.S. assets in ETFs has grown more than 30% this year. It's according to Tidal Financial Group. Looking ahead to 2025, we want to talk about some of the themes and get some recommendations within the ETF space. Joining me now on set is Michael Venuto, Tidal Financial Group Chief Investment Officer for this week's ETF Report, brought to you by Invesco QQQ. Michael, great to see you. Great to have you here in studio with us.
Yeah, wonderful to be here, Brad. It's been a great year.
Let's start broad here. What are 3 sectors that you think that people should be looking at in 2025?
Okay, so the obvious one is always tech, right? But most of us own some broad-based index, and you have the big tech names. So I would look to more niche plays, something with AI like chat or blockchain. We're going to see a new administration that seems to be very interested in promoting those kind of technologies here in the U.S. So BLOK is one of the funds on our platform, things like that. I'd also look at financials, but again, I'd get more excited about things that are a little bit less big broad-based banks. The JPMorgans, more the Squares, PayPals, things like that. And then finally, it's been a surprise hit this year. Nobody would have thought it, but utilities I think are really interesting, right? Yeah. They always do well with deregulation, and it's a nice play to have if things don't go well.
Right. Also a tangential AI trade as well that we've seen play out here. I want to talk about the growth of single stock and leveraged ETFs here. What have you been able to see within the flows and how that's being used as a mechanism or at least a portfolio strategy?
Yeah, I would say that these are trades, right? There's a lot of opportunity to give people the package that they're doing on their own. Now, as an ETF, you get more tax efficiency, you get all of the great stuff that comes with a bigger scale. So we've seen massive growth in the Yield Max suite. These are funds that are basically doing covered calls, right? So you're giving somebody exposure to MicroStrategy or Tesla or NVIDIA, but you're also generating income off of it. You've also seen the other opportunities with leveraging these types of names. So I think we're going to see more and more of that. It's been a pretty exciting year for that, and it's really more people doing it themselves.
Yeah. I mean, your firm filed plans with the SEC in October to launch 8 leveraged ETFs called Battle Shares that basically pits one stock against another. For example, leveraged long position in NVIDIA versus a leveraged short position in Intel. Just talk about the appetite that really led you to put together these types of funds, and where you anticipate this kind of growing out towards in the future?
Yeah, so Title's an ETF platform. So we actually do this for clients. These ideas come to us in ways where we develop them with a client. And the client in this case saw an opportunity to prepackage trades that we're seeing retail investors as well as traditional hedge funds do. Now we're putting it in a wrapper that just simply makes it more accessible. We're really excited about it and the buzz around this one. But at the end of the day, these are trades people have been doing, and we're just making it more efficient through the structural alpha of the ETF wrapper.
I want to pivot to crypto here with some of the time that we have left. According to an analyst at Bloomberg, U.S. spot ETFs have more Bitcoin held than the founder of Bitcoin himself, Satoshi Nakamoto. What are you seeing for crypto ETFs as you look out to 2025?
Yeah, I mean, obviously it's not going to stop, right? There's an institutional adoption that has happened, and I can't believe it was BlackRock that really kicked it off, right? You would have thought it would have been a crypto native, but it seems like...
Well, not for lack of trying, too,
Not
right?
for lack of trying, yes. I do think that it's likely we start to see more, call it package product or index-based types crypto funds, right? So now we have Bitcoin and Ethereum. There are filings for Solana. There are filings for one other one that I can't remember off the top of my head. We haven't seen a Dogecoin filing yet, but I would imagine it's coming. So I do think with the new regulations and things that are coming, it's likely that we're going to see more and more people accessing that market.
Entering today, I had 16 S&P 500 year-end price targets on our graphic that we always put up on screen here and on the website. All of them had stocks ending higher, right? Somewhere in a range of 6,400 to 7,100. Our 17 strategists, Barry Bannister from Stifel.
17th to chart.
Finally, we have a bear. Someone says stocks are going to fall, right? And I think when you dig into what Barry's saying here, of course, if someone's telling you that stocks are going to fall in 2025, they're probably going to talk about valuations, right? They're going to talk about how that puts maybe this market rally on a little bit of thinner ice. But what I think is interesting is what Bannister's getting at is something that is becoming a little bit part of the discussion right now as far as sticky inflation probably leads to less Fed rate cuts. And then the real kicker is a weaker economy. So one of the things we've talked about with all of these bulls and the large thing that people feel like is going to go well is a better than expected U.S. economy. That's been the trend since post-pandemic, is the U.S. economy has grown better than consensus. Well, Bannister thinks the U.S. economy probably grows at about a 1.5% annualized rate in the second half.
How does he get there, Josh?
It seems like overall, it's the impact of higher rates too, Josh. Remember, we're going to come back to that conversation, I think, in 2025, that eventually holding rates higher for longer does something to the economy. It hasn't to this point. That recession that we talked about for 2 years has not come, but there is still a take out there that at some point that's going to happen. He's talking about the consumer here. Consumer spending would slow down, then your economy slows down. And this reminded me, guys, of a chart that we highlighted a week ago in our Morning Brief newsletter that Lori Calvasina shared from RBC on how markets do in different GDP regimes. So if you look at GDP over time, here you go, 1.1 to 2%. So that's Bannister's range, right? That's when the S&P 500 has not had positive returns. Where most strategists sort of sit right now would be right below that, predicting GDP in 2.1 to 3%, and you get about an 11% market rally. So again, kind of the key thing here being, if we're expecting the economy to do well, and markets are in large part about expectations, if the economy underperforms, maybe there's a concern not only is the economy slowing, but slowing to a point that we're starting to talk about recession again, and you're starting to price in more risks. Right now, it feels like this market is not pricing in a lot of risks, is something that not just Bannister's saying, a lot of strategists are saying that. The market is not pricing in a bad year for the U.S. economy, so if it comes in a little bit worse, that's when you start to talk about pullbacks.
Barry's been bearish, has he not?
He has been, he's been bearish, right. And so I think really, which is why I'm sort of saying the takeaway here is perhaps he's just staying with the risks here that everyone else is a little bit ignoring. But I have heard from a couple strategists in the past week that's been interesting thinking about the different scenarios that a higher inflation regime could lead to in 2025, right? The team over at UBS Asset Management was saying, well, if we have higher inflation and everyone's pricing in these Trump tariffs and these other things that could be inflationary, what if the president-elect decides, I don't want to bring up inflation higher, and he doesn't do any of the tariffs, and all of these things we've been pricing in the market and all of these outcomes don't actually happen?
than maybe your US exceptionalism thing, as you guys were just talking about. The US economy is supposed to do better than other economies, partially because of tariffs, right? If we slap tariffs on all of these other economies, it's in the model, Julie. I see your head moving. It's in the model. It's part of the model, at least. So if you take the tariffs out, then maybe there's opportunity elsewhere outside the US equity market. It doesn't necessarily mean the US equity market doesn't go up.
Just on a relative basis.
But on a relative basis, we're constantly talking about where you can make more money. And maybe there's a chance to make more money elsewhere if tariffs don't come, was one other interesting sort of thread here that's been floated around.
So as you look ahead, Greg, and you think about the state of the IPO market in 2025, what would you say, break it down for us, are the tailwinds?
Well, listen, I think we had the wet blanket of the election, right? The uncertainty around what was going to happen, what the new tax environment was going to be, what the regulatory environment was going to be. And so this election years often have, some of these issues. Now that that's behind us, with the new administration coming in, and, I think there's a lot of tailwinds in the market. We've actually seen the markets, kind of have an upward trajectory since the election. So that uncertainty was definitely a big overhang on the market. I think there was some recession fears earlier in the year, and I think that people are feeling generally better about the economy. We're going to be entering into, either a stable or declining interest rate environment, and certainly for tech companies and growth companies, those are good indicators of success in the future. And frankly, we have a pipeline of, really quality private companies that have been sitting around waiting. And so I think the market is going to see an inflow of really high quality, good growing companies that they haven't been seeing in the market for a while. So I think that all bodes well for a good IPO market in 2025.
Let me get you the skeptical take, Greg. I want to get your response to this because we've had some venture capitalists on the show, and I've asked them the same question, and they were, I think, kind of more pessimistic about the strength of the IPO market next year, Greg. And one reason they gave me was, listen, they said, Josh, these tech startups they've raised so much money that these founders, they're kind of good for like the next 12, 24 months. What do you make of that argument?
Well, there's certainly a subset of companies like that. There's the companies like Stripe and Databricks and SpaceX and OpenAI and, what I would call the granddaddy type companies who have plenty of access to capital, have raised a ton of money, have provided liquidity for shareholders and investors pretty consistently for a long time. Those are the haves. And then listen, there was, a strong private financing market kind of in the 2021 timeframe where some of these other companies raised a bunch of money, but there has been a dearth of liquidity. There is a need for liquidity for, the next level of companies, not with a real strong AI story. And I think the public markets are offering, really good multiples right now. And there's a lot of interest in these companies. And so I do think that this next rung of companies, and I would consider ServiceTitan in that kind of 5 to 20 billion market cap type range, so not the 4 companies that I just mentioned, I do think that those companies, will be accessing the public market. So I'm much more optimistic, and those are good quality companies in that group. And we can talk about, who some of those companies might be, but I'm much more optimistic about those companies going public versus, maybe the top 4 who could probably stay private as long as they want.
Another name I'm just curious to get your take on, Greg, Klarna, because we just had the CEO of Klarna on the show today. Is that another name on your radar?
Yeah, 100%. I mean, that's in that rung of 5 to 20 billion market cap companies. They've been on file for a while. They, more recently just came out with a new S1. I expect them to be probably the first $1 billion, IPO raise in early 2025 , and I think right behind them we just saw CoreWeave is racing to confidentially file their IPO. That's an AI infrastructure company that I expect to see coming out in early Q2. We saw Chime recently announced that they had picked bankers for an IPO, and so I expect to see an S1 from them as well. And listen, a lot of people are paying attention to what happened today in ServiceTitan. And I think they're excited about what they see.
Well, no one knows exactly how 2025 will shake out. Our next guest and her colleagues have attempted to identify at least the themes of next year in order to figure out how to benefit from them. Joining us now, Lisa Thomas, TD Cowen Deputy Head of Research. Now, you had a lot of themes that you were looking at here, a dozen of them. We wanted to sort of drill down on a few. And there's a lot that we've talked a lot about already, things like geopolitics. So I want to start with one that is less on the beaten path, and that's shifts in demographics. What are we seeing in shifts in demographics, and how is that going to affect the economy and how people trade?
Sure. So the biggest shift in demographics that we're seeing is something that we started to see in our TD Cowen proprietary monthly tracker, where we go out to 2,500 U.S. consumers each month on a census-adjusted basis. And that really helps us pull back the aperture beyond our single stock work. And I have to tell you, the 65-plus population surge, the silver tsunami, is really significant. So by 2050, you are going to have nearly a quarter of the population that is 65 or older. That's up from 18% right now. And there are huge implications, big, in big ways and then in everyday ways. So at a macro level, you have to think about things like home renovation, because nearly 75% of the people that we've spoken to in that cohort do plan to or hope to age in home. And so there's a huge amount of home renovation that's going on as they modify their homes to make way for aging in place. That's just one example. And when you think that that's $1 trillion market in North American home renovation, we think that under some scenarios that could continue to grow another, at a 5 or 6% CAGR, which is very significant.
Wow.
And Lisa, are there certain ways, if you're an investor, you're listening right now, are there names that you would say, listen, that's a potentially smart way to invest in that theme?
Yeah, well, it's funny, on the everyday side of the spectrum, one thing that came out of our work is coffee. So it turns out when you get older, you drink more coffee. And I found that was really an aha moment for me, because I thought, am I crazy or am I drinking a lot more coffee? No, in fact, I am, and so is everyone else. And so within consumer for 2025, Dutch Brothers is one of our best ideas for 2025. And our senior analyst, Andrew Charles, thinks that there is a lot of underappreciation of the innovation that company has been advancing in mobile ordering, in menu innovation, also in loyalty program, which, by the way, is really significant and important for the older cohort. So as I say, in big and small ways, it's something that really presents.
One of the other big themes you're looking at is reindustrialization here in the U.S., or reshoring, a lot of people call it. We've been talking a lot about tariffs, less about that sort of side of that equation, which of course has begun under President Biden with the CHIPS Act and some of the other measures. So how does that trend then look over the next year and over the next 4 years, for that matter?
Yeah. Well, look, I think it's a huge trend. It's much more fun to talk about than tariffs, too, so thank you for that. But listen, I think President-elect Trump, even this morning at the New York Stock Exchange, was saying he wants to be in a position to permit nuclear, within a week. And so I think that you have a really interesting convergence between the key policy pillars of America First and then the kinds of advances that the big tech and other proponents of AI are going to want to see. If you think of the fact that energy and infrastructure are the biggest limitations right now that are kind of slowing the advancement of AI, if we can actually grow our energy capacity significantly, if we can remove those infrastructural barriers, and that's going to really advance the AI dominance that President-elect Trump has spoken of, and certainly energy dominance as well.
I'll ask you the same question, Lisa, off that theme.
Yeah.
What would you pick?
Well, I hate to disappoint, but Mag 7, Amazon. We just came out this morning with Amazon as one of our best ideas again in tech. Our senior analyst, John Blackledge, thinks that there continues to be growth from here, even on the 50% plus run that it's had this year. That with its role as a hyperscaler in the space, it's really, really levered to that theme, that it has margin expansion that it can continue to see from here, including certainly from AWS business, but also even just in some of the advances in e-commerce, in efficiencies from fulfillment. So it still has a lot of different levers. We think its net cash is actually going to double from this year to hit roughly $133 billion. So even with all of the run that we've seen, we think that that's an important way to play that theme.
Yeah, it just closed at a record yesterday, but it pulled back a little bit today.
I know.
And then another one of the themes is healthcare innovation. And I found this one really interesting, given, healthcare right now, just the broader industry, you've got patent cliffs at a lot of the big drug makers. You had the obesity run, but then you've seen a pullback in some of those stocks. And then, of course, we won't even get into, the pharmacy benefit managers and all of that. So healthcare innovation, where does it fit in with all of these cross currents?
Sure. Well, you know what I think is that, you mentioned the obesity run, and I think that's really important because obesity, I think, is really just the beginning of something bigger. When you think about that class of drugs, now we all know what GLP-1s are and semaglutide, that's really about, regulating metabolism, and it really points to a whole host of metabolic, conditions and processes. So we think that that whole class of drugs and derivations around them are going to become really important. Obesity is really just adjacent to or a precursor to over 60 other conditions and nearly a dozen cancers. So we think some of the other conditions that you're going to start seeing, tied to treatments, using drugs of this class are really, really significant. And there are some phase 3 trials and data that are coming out, relatively soon that I think are going to put a lot of attention on that when you think of cardiometabolic and a whole other host of, inflammation, inflammatory, all kinds of things that could be treated by this class of drugs.
So how should investors be thinking about the setup as we look into 2025? We have certainly gotten so many market outlooks here over the last several weeks, and it seems like the resounding consensus is a bullish setup heading into the new year. I guess more specifically, what do you think that is going to look like?
So I think the question is for us, certainly as we look at the next year, what has already gotten priced in, right? So there is a lot of bullishness that came out soon after the results came out of the election. The fact that the Republicans are going to control all the three houses, the 2 houses and the White House. Now it's a lot about what the actual earnings are going to look like for firms. I think that has not changed. Unless we see a follow through of these elevated valuations by a really corresponding increase in earnings, I think this rally can sort of pause. Our perspective, looking at the last administration, we do think one area to focus in on is CapEx. CapEx is a really nice theme. We think it's an enduring theme for a few years, and we're looking to play that in every possible way. In public markets and private markets, private credit, infrastructure, everywhere we can. The combined effect of both the Biden administration's spending on CHIPS Act, IRA, that's likely to continue for several years, plus the move the Trump administration is looking to make with regards to deregulation, potentially bringing down corporate taxation, all that plays really heavily into this CapEx theme. So I think that's where we feel most comfortable about. Today, at a very high level, looking at the S&P at whatever 22, 23 multiple, it needs to have earnings that build into that multiple. The current expectation for next year is about 30% consensus. We're somewhere a little bit lower than that. We think maybe it's 11 or 12%. The market is pricing in closer to 20, 23%. I think that's the part that you've got to put some emphasis around. We do see generally a broadening of the rally. So we do think some of the sectors you were talking about, small caps, financials, could grow and show some nice earnings. But it's really a lot about earnings as we look at really what is it that's going to drive the actual, can the earnings grow into the valuation that we're seeing today?
Certainly. A lot to unpack there. I want to focus in on the CapEx component that you were mentioning, because how do you suspect that investors will grade the type of CapEx and the scrutiny, I guess, in some of the spending or intention of the capital expenditures that companies are announcing and putting forward, and how and on what time frame should they expect real gains to be actually priced in to the valuation and put into the valuation based on kind of the realized financial performance?
Yeah, so I think that number one, like if you think about strategic sectors, like chips is the one to think about for a second, right? There's a lot that's been done, a lot of plants and a lot of things being put up. We have to see what the execution is going to look like on that front, but we feel pretty comfortable and confident that there's going to be some moves in that area. We're very comfortable and confident that the AI theme is going to continue. So again, data centers, the energy needs, which are massive by any stretch of the imagination. The amount that's already been allocated by the Congress towards infrastructure, but has actually not been used. So industrial sectors, defense, I think that's going to be an area where not only the Trump administration, but I think on a global basis, you're going to see a lot more expenditure occurring in that area. So those are the sectors to look at, the industrial sector, the construction sector, the defense sector. Those are the places we're going to see some chance to play into that. On the private side, I think still there's a lot to be done with roads and bridges, renewables on the energy side. Those are the real nice things to play on the private side.
We want to bring in our first guest here. We have Paul Meeks. He's the Chief Investment Officer at Harvest Portfolio Management and partner at Wall Street Beats here. Paul, it's great to have you. Let's start on some of the comments that we just got from President-elect Donald Trump, what he plans to do in terms of deregulation. He talked about the fact that he wants to bring the corporate tax rate down to 15%. As a close insider and someone who closely tracks the tech industry, here we are with tech at record highs. How much more momentum could this potentially add to that trade?
Well, the first thing I'll say, because I was listening carefully to his comments a moment ago on your program, and even though there has been chatter about the corporate tax rate going from 21 to 15%, ever since Scott Bessent has been named as U.S. Treasury Secretary, he's really avoided that question and focused on other aspects of fiscal stimulus. And so today, for Trump to say that, and of course there's a caveat where you must manufacture your products in the States, that is actually a confirmation, if we actually carry through once Trump is sitting in the chair in late next month, that there could be another nice win. Because I've always been a bit skeptical if that was campaign rhetoric or if that was real, but he doubled down on it today. And let's see if Scott Bessent, when he is alone talking on the networks, sings the same chorus. But that was the takeaway I had today. As far as the market going forward, we've probably taken a little bit of next year's run in stocks and pulled it forward, with Trump being one of the key factors for that. But I still think if we were to talk a year from today, right, we're wrapping up 2025, I imagine that the tech sector again outperforms the overall S&P 500, and that the S&P 500 doesn't have such a big gain as it's had. It's been over 20% each of the last 2 years. And we all know over about the last 100 years of the financial republic, stocks do about 10% per annum. But I still think it's reason to be constructive. And so I am very careful with my tech picks because some of them have run. So my fresh money buy list has shrunk somewhat. But in those names, I'm still bullish.
What's on your fresh money buy list? If we did see indeed a pull forward in some of the market activity or performance to the upside, and that would potentially hold in your view that we could see some type of pullback. If we did see a pullback or even a correction next year, what are the top names that are at the top of your list right now?
Well, everybody asks me about the Mag 7 continuously, and I will tell you that I'm refined with my thinking there. Of the Mag 7, the only ones I really support for growth and valuation at this level are Amazon, which I think will see a nice upside surprise when they report, and also NVIDIA. And I know that NVIDIA is working on a triple this year, and the stock tripled last year. However, their growth and their growth prospects have eclipsed that. So those are my two favorite names among the mega caps. I am going to, at least in the early part of 2025, stick with my AI infrastructure building plays. Those are primarily semiconductor companies like the aforementioned NVIDIA. I'm also starting to warm up to advanced micro devices because it's come down a lot. I like Broadcom, which will be reporting tonight. And I also like Marvell and Taiwan Semi. I am not sold, and this is reflected in Adobe's atrocious run this morning, that the AI software companies, the beneficiaries of the AI infrastructure build, will see the goodies so soon in 25. And also, even if they have AI use cases, they're not showing yet. And I need to see some evidence that they're monetizing that business.
For more on the big themes to impact the banking sector heading into the new year, we want to bring in Alex Blostein. He is Goldman Sachs Global Investment Research Senior Analyst. It's great to have you on the program. It's tough to have a conversation with one of the top strategists on Wall Street and not talk about the opportunity that lies ahead for the financial industry. I'm curious, as you just wrapped up your 2-day financial services conference, what was your biggest takeaway just in terms of some of that optimism and confidence that you heard as you look ahead to 2025?
Yeah, great. Well, thank you for having me. Pleasure to be with you. So we did host a conference over the course of the last 2 days. We hosted about 100 executives across financial service industry, ranging from banks to brokers to asset managers. So it's a really wide range of perspectives. So it was a great way to get a check on the pulse of the industry heading into 2025. And what I would say is there's a number of takeaways that really stood out. To your point, there's a lot of optimism there around the economy, and we got a couple of data points supportive of that. I'd say second, the amount of capital market activity, the pent-up capital market activity, seems to be translated into some of the more actionable steps. So whether it comes to equity markets or M&A activity, that is likely to accelerate pretty materially into 2025. The other theme we've heard, and you mentioned private credit, but I would expand it out a little bit broadly. All things around private markets continue to feel really healthy. And for the last several years, it's been largely the story of private credit. We're starting to see that broaden out a little bit into private equity. It sounds like things in real estate are starting to get a little bit less bad as well. And the last point I would make, and we can dig into all of these, there's still tremendous amount of capital sitting on the sidelines. So there's something like $7 trillion of money sitting in cash, money market funds, that is starting to make its way into the market. It's starting in fixed income. It may extend into equities. But all of these things seem to be really bullish for financials into 2025.
What's kind of the third level play for the money market funds, that cash sitting on the sidelines? How likely do you think it is that we could see some of that money flow into something like private credit heading into 2025?
Yeah, so these are kind of slightly different factors, I would say. The growth in private credit has been a bit more structural, and we continue to like that theme a lot for the whole space. It has been unfolding on the institutional side for quite some time. Wealth management and retail has been a newer growth opportunity for the space. We've seen a number of very large asset managers pursuing this opportunity both organically and inorganically, and that is likely to continue. We don't really see any signs of that slowing down. The more cyclical aspect, which is more traditional style funds, is where you're probably going to see a bigger incremental impact from a cyclical perspective. So that $7 trillion that I mentioned, typically that would go into bond funds or equity funds. We would have thought that the fixed income industry would have seen more of that flow at this point in the cycle already. That hasn't happened yet, but as rates start to come down and the yield curve steepens, we think it's a tremendous amount of capital that can move back into the market.
Alex, you mentioned that deal activity. You mentioned some of the confidence that you're hearing from executives at the conference, also I'm sure from some of your clients. When we talk about what that uptick is going to look like, I guess how big of a dramatic change are you expected to see here in the next year?
Yeah, so the two areas that people will talk most about is equity capital markets and M&A. On the M&A front, we are running about 10 to 15% below cyclical averages, and that is not adjusted for the notional, right? So the markets went up quite considerably. So you could argue you could be up, 15, 20, 30% in terms of M&A volumes over the next couple of years. If you look at the equity capital markets, in 2024, I think we've been running something in the 30 to 40% below where we peaked in kind of 2021 period. And there's a lot of pent-up demand. We think a lot of companies that I cover, the private markets firms, private equity firms, they have not returned a ton of capital to their clients over the last couple of years. So we think they will use both the M&A route as well as the equity capital markets route to get some of that capital back out. Because frankly, two things, right? Financial conditions are very easy. Spreads have contracted pretty materially. So availability of financing across the banking industry and the private credit industry is probably as good as it's been in a long time. So financing conditions getting better is a good sign. And then, of course, equity market valuations are running pretty high as well. So that should give people an opportunity to actually deliver on some of those exits.
So to put a bow on this a little bit, do you anticipate 2025 finally being a big exit year?
It feels like it, right? When you take that pent-up demand and when you also couple that with probably a more relaxed regulatory backdrop, that should feel pretty good. Whether it's antitrust dynamics getting a little bit easier, or as I said, just financing conditions continue to be pretty strong, I think that creates a pretty healthy recipe for some of that exit activity to finally kick in.
Alex, investors right now, or our audience who's looking to take advantage of this, what's the top pick then, the top play?
Yeah, look, we continue to like alternative asset managers. It's the space that we've recommended for quite some time. Some of our top picks there continue to be KKR, Apollo, TPG. TPG is a place where the multiples have not run as much, and they're quite levered to this private equity cycle. It's still the majority of what they do. When you look at KKR or Apollo, very different type of companies, but levered to a lot of the same themes as well. With Apollo in particular, you brought up private credit. It's a place where we continue to see a long runway, and then they're one of the better companies positioned to benefit from that as well.
I am focused basically on information technology. That is my favorite sector going into 2025. And in second place, I would say very selected retail and consumer discretionary. In the IT space, companies like AMD, NVIDIA, Palantir, First Solar, I think there's all good, solid picks going forward. And in the retail space, I believe that consumers are out there, they're spending money for the holidays and so on. And Burlington Coat Factory, BURL, is one of my top picks there.
And so, all of these things in mind, is there one theme that you believe that we've seen play out in 2024 that could also permeate over into 2025?
Oh, it's definitely artificial intelligence, and continued growth in data centers. This is just the beginning of a long-term ramp up. So, it's going to carry into 2025, 26, and God knows when. I expect it to go on strong forever and then get into a cycle mode. By that, I mean that once you buy your chips and so on, 5 years from now, you're going to buy new chips to do even better. So, you have an updated PC cycle, so to speak.
So with that in mind, and I think you're kind of alluding to something that a lot of analysts have been trying to wrap their minds around, which is a chip replenishment rate, how quickly the burn off of chips would take place and thus require them to be replenished or replaced within some of the data centers as well here, and the pricing at which that would be anticipated to take place. So as you're kind of looking across your own portfolio, and even if that is the theme that is perhaps the most prevailing that could permeate over into 2025, what's your assessment of how companies would go about navigating the pricing landscape and make sure that investors are clearly not grappling with, but understanding that story?
Right. I think the story, the AI story, will be self-explanatory going forward. It's a little bit tricky to wrap your head around, like you mentioned. And I believe, and I've read some things that are people wanting it to see the benefits tomorrow, from an investment they made yesterday and so on. So they got to be a little bit more patient, but AI is a transformative technology. It's not just one thing, right? And to put it in simple terms, we're talking about learning, artificial learning. We're talking about speech recognition, sound recognition, vision. So if you think about all those things where they can put to good use, including image processing, let me give you an example just to make it my point here. If you have an empty lot sitting around the corner, and all of a sudden you can get this software and it has AI and it has all the rules and regulations in a module for the county, all of a sudden you can design a building and 10 or 20 different designs on that lot, all with the plumbing, the electrical, pretty much like this, because they're images at the end of the day following certain constraints. So that's an example how AI can really transform many different industries. It could be health, care, insurance, and so on. So I think this is just the beginning of it, and it's really hard for a lot of people to get their hands about where the future is. The future's never that easy to predict.
Certainly.
So, yeah.
I want to come back to one of the other themes that you mentioned as well here, and you talked about the consumer. I wonder what you're noticing among the consumer this holiday season and what that kind of spells out compared up against the resiliency picture that we've heard and witnessed out in some of the economic data readings as well.
Well, that's all good for now, let's put it that way. Come 2025, there's talk about tariffs and things of that nature, and I am concerned about that. I think that at the end of the day, the consumer is the one that suffers from those things. Right now, they're outspending, and they're looking for value stocks. For value in general. So that's why, like, for example, Burlington Coat Factory, they get other people's excess inventory. And this is what probably going to end up in 2025 with a lot of excess inventory as companies prepare for tariffs maybe and just overstock. They buy too much of things because it's hard to predict and it brings in volatility. So we'll see how that goes. And I think consumers will be impacted by that. So that's one of the risks going into 2025, and I'll certainly keep my eye on that one.
And so just lastly, while we have you here, we typically would have been, for much of this year, talking about the risk that the Fed has within this broader kind of portfolio makeup that you've been laying out. But it seems like the Fed's on the back burner now, and it's all focused on what you just mentioned a moment ago in the incoming administration, the risk of potential tariffs, and the unknown there. How would you be structuring your portfolio to outlast any of those potential threats?
No, that's a good question. So the way that we pick our stocks in our portfolio is we use a house-grown investment process, which we call quant active, which is basically a quantitative layer that looks at the hard numbers regardless of emotions, and then it follows it up by me. So we take a hard look at things and look where the market is at. But in general, what we're looking for is stocks that have accelerating earnings and revenues. No matter who's in government, you want stocks that are growing and that are generating legitimate profits, organically. For that reason, a lot of these semiconductor companies pop up. They just show up in our processes, and that's why the process is dictating to us that going into 2025, it's in great shape. It's because of that. The fundamentals are strong and the demand is there. So if you get into more speculative sectors like consumer discretionary, then you're going to have some bumps because of the tariffs and so on. But everybody's going to need technology going forward.
We're wrapping up a great year here as we roll into 2025. You tell your clients, Scott, broadly stay positive. How come?
Well, I think the underlying fundamental trajectory is in really good shape. We've been pitching this no cycle thesis for the better part of this year, which basically says we're in this ongoing paradigm still coming out of the pandemic. And what we've seen is a fairly resilient fundamental circumstance and economic circumstance, even against 2 years of Fed hawkishness. So now we're kind of navigating, let's call it policy uncertainty with the new Trump platform, ultimately should give way to policy opportunity on the other side. All told, fundamentals look in really good shape going into 25 and should persist into 2026. This keeps us pretty constructive on U.S. equities.
Well, and Scott, that also implies that you think that policy uncertainty will resolve itself in a way that is favorable or at least not harmful to the earnings growth and stock returns that people have become accustomed to over the past few years.
So, we don't have a lot of information now relative to what we had even 2 or 3 months ago. So we've done a lot of back of the envelope modeling on this. And our high level takeaway is that we're probably going to see some company specific industry group or sector responses to some of the specifics around tariffs, deregulation, maybe tax reform and so forth. But all told, we're looking for low teens increase in S&P 500 earnings next year. And we don't think that the Trump policy impact will detract too much from that underlying trend.
Scott, looking back on 2024, what surprised you as a strategist?
Yeah, I don't mean to say this in a sort of a comical fashion, but if we were having this discussion in the early part of January, and I would have told you that the S&P was going to finish the year 24, if not 25 times earnings, I'm not sure you would have invited me back on. But essentially what this has been one big valuation surprise. Earnings expectations for full year 24 are not too far off from where we were looking at the beginning of this year. So essentially it's been a valuation move dominated by the Mag 7 mega cap growth cohort. But essentially it's been this ability of investors to look through a lot of the near-term noise around Fed and economic activity towards its underlying fundamental improvement, pricing in soft landing, AI growth tailwinds, and now to come probably still some opportunity around the Trump platform.
Scott, you mentioned valuation, and there was an interesting chart that you all put in your outlook where you looked at the forward price earnings ratio of the S&P 500, of the Magnificent Seven versus the S&P, and then versus the S&P minus the Magnificent Seven. Now, looking at this chart, it's clear, obviously, that the Mag 7 are trading at higher valuations. But what are your other takeaways from looking at how valuations have developed here?
So, this is the great storyline. So essentially, if you look at the Mag 7, their forward peg ratio, as we call it, has actually come down, right? So the Mag 7 is trading maybe 90th percentile versus history, but what's been happening is that the earnings growth has been so strong, it hasn't led to a dramatic valuation increase. These are high multiple companies anyway. On the other hand, the other 493, which is going to encompass the big chunk of the market, obviously, is actually trading at a more expensive valuation versus its own history. What this tells you is, to my earlier point, the market is quickly pricing in a lot of soft landing enthusiasm, AI tailwinds, and then, as I mentioned, the opportunity around the Trump policy platform. So it's this other 493 that we need to see stabilize from a fundamentals perspective and then broaden, and we think that's going to be the case for next year.
Do you think, Scott, when you look at people, folks piling into these Mag 7 names, and you could look like an ETF like the Mags, for example, which is hitting the record. How much of that is earnings, Scott, and how much of that is also perhaps a defensive move here? Meaning, if you think inflation is maybe proven a little stickier than some imagined, and rates are higher for longer, investors start looking for what they would consider more defensive names.
Yeah, it's a really good point. So the way we're talking about it more recently is that we're thinking the Mag 7 actually unfold as a quasi-staple, right? So usually you go to staples when you have uncertain economic conditions because of the persistence of earnings growth. The Mag 7, we think that forward-looking earnings growth certainly for 25 and probably into 26 is fairly visible. So all told, when you get concerned about other things that work in the market and the economy, the Mag 7 actually have this potential to be a, quote, defensive, if you will. We use the phrase growth is defensive periodically, and that's what's going on here. So essentially, I think that's what we are looking at is near term, let's call it probably 2 years visibility. That's pretty good for these companies. What the issue becomes with them is whether that perpetuates in, say, years 3, 4, 5. And the market's starting to price in that perpetuation. So we need to be sensitive to both sides. These companies probably can't just live on meeting expectations. They need to continue to meet, beat, and then probably raise forward expectations as well.
Well, and Scott, sort of to put a fine point on this and also combine it with the last point you were making, everybody is talking about broadening, including you, and that is necessary for the rally to keep going. But it hasn't necessarily been necessary in the past. In other words, in the past, the Mag 7 going up was enough to pull along the rest of it. What changes in 2025 that's not going to be enough anymore?
Yeah, well, I think it's law of numbers, law of large numbers, and can they continue to grow earnings at their current pace? One of the themes that we think is at play for next year is what we call earnings growth rate convergence. And essentially what happens, if you look at the projections for the Mag 7, they're still growing quite notably, but it's at a decelerating clip versus what 23 and 24 was. On the other hand, the other 493, the value side of the S&P, even going down into small mid-cap, all of them are coming off of relatively flattish earnings growth years where the inflection now presumes to be to an acceleration mode. And so what ends up happening is that the growth rates between mega cap growth and these other elements of the market begin to converge. We think that's a really positive sign. And I think in terms of a healthy way to future market gains, you really want to see this broadening effect kick in, and we're pretty comfortable it will.
And Scott, you mentioned the Fed earlier. I'd love to get your take. What do you expect at the big meeting this week? What do you think they'll do, Scott? What should they do, in your opinion?
Well, I think another 25 basis points makes a lot of sense here. I mean, they're going down a less restrictive path for sure. We've begun talking a little bit more about a new Fed normal, and that is, I think equities are in good shape with the current market implied trajectory of, let's call it 100 basis point reduction over the next year. It's probably going to be with fits and starts, but all told, I think what we have to expect is that the Fed obviously has its eye on the ball here, and this gradual reduction in restrictiveness makes a ton of sense from our perspective. And so all told, what we're looking at the Fed is that it's going to be an important dynamic at work here. I think probably at the margin, we're going to be a little bit more focused on where some of these Trump policy proposals take us.
And finally, Scott, is there a place, beyond just the broad averages, are there specific sectors where you think investors should be looking next year?
Well, we haven't updated our year-end sector playbook, but going into Q4, we feel pretty good about the positioning. And essentially, we've been thinking about this fully valued market in a bit more of a, what do you like versus what you don't like. So we've been looking at sectors paired against each other. So for example, we've been talking about financials in overweight versus healthcare underweight, consumer discretionary overweight, which has been pretty controversial against an industrials underweight, communication services, which is where you catch the internet names, overweight versus consumer staples, And then lastly, we've been working energy against materials. So all told, we think under the index surface, there are lots of pretty intriguing sector setups. Tech's a little bit unique here. We're market weight tech. We actually prefer semis a little bit more right now versus the strong performance we've seen recently in the software side.
With that 25 basis point rate cut expected later this week, it's a good time to consider bringing your cash investments off the sidelines, perhaps. Here with the top reasons he thinks fixed income is a good place for investors in 2025, we've got Dominic Papalardo, who is the Morningstar Chief Multi-Asset Strategist. Dominic, thanks so much for taking the time here today. So why consider owning bonds as interest rates come down?
Yeah, thanks for having me, Brad. A few reasons. The most obvious one is there's no longer a yield give up to move out into longer maturities. For much of 2022 and 2023, the curve was inverted, meaning short yields were higher than long-term yields. That's sort of normalized now, and the curve is pretty much flat. So cash rates are around 4.3%, and really any maturity along the yield curve is in the 4.2 to 4.4% range. So there's really no cost to making that trade today.
You know, as we think back to last week, U.S. Treasury yields rose to the highest level since late November, as I'm reading through a note from UBS in my inbox here, even though markets remain convinced that the Fed will cut interest rates further when the FOMC meets this week. How should that be priced into or play into investors' strategy here as they think about this specific asset?
Yeah, Brett, we would agree that more rate cuts are likely to come, particularly through the first half of 2025. And what those rate cuts represent is the opportunity for those longer maturity bonds to actually show price appreciation. So whereas cash can only generate total return through a function of income, longer maturity bonds could produce total return from income as well as price appreciation, which should occur as rate cuts are realized. And additionally,
Sorry, go ahead.
I was just going to say also those cash rates will also decline as rates are coming down. So even that 4.3% cash yield that's available today will dissipate rather quickly as further rate cuts come down the line.
How can investors identify quality bonds and kind of pair that with the expected returns?
Yeah, if an investor is focused on quality, we'd be proponents of adding to U.S. Treasuries. Obviously, they're relatively risk-free as they're backed by the U.S. government. And the yields there are appealing on a real yield basis, meaning that the actual yield of those bonds, even after the current inflation rate of about 2.7%, still generates a positive return for investors. And certainly there's more volatile options in the marketplace away from those high-quality bonds that we could talk about. But if an investor is risk averse, we would say U.S. Treasuries are the way to go.
And so how would you then identify some of the emerging markets as well?
Yeah, we like emerging markets more than we like U.S. corporate credit. Some of the emerging market debts, when you look through that valuation lens of real yields, Brazil, for example, has 5-year bonds yielding over 14%. Mexican bonds are yielding around 10%. And they both have inflation rates around the mid 4% range. So very attractive real yields. Again, those countries will be more volatile as they're rated below investment grade. But for investors that can accept that risk, there's definitely some upside there. When you compare that back to, let's say, high yield corporate bonds in the US that are also below investment grade, their valuation metrics when using credit spreads or the additional spread over treasuries is very, very low. It's in about the 5th percentile of history, meaning that additional compensation for the credit risk has only been lower 5% of the time over history.
Where do you think the real mix and the sweet spot for the mix of a portfolio holding fixed income is right now, especially as you've got some of the largest institutions now initiating their own, not coverage all out, but their own recommendations on how much Bitcoin and cryptocurrency versus fixed income versus equities should be held?
Yeah, Brad, we really still like the intermediate range of high quality bonds. When you think about how that fits into a diversified portfolio, fixed income today, because of the yield rise we saw in 2022, is able to offer some hedging protection. So if we get an environment where, let's say, equities become volatile and see prices fall, we would expect that high quality fixed income allocation to rally and really offset the losses being experienced from the equity side in some ways. That didn't exist. That protection wasn't available when rates were near 0%. But now that we're back to the mid fours, there's room for those rates to fall and provide that ballast to a portfolio. And we think that's a prudent choice to make. And we would remind investors to treat fixed income as something that could be conservative and helpful and not just chase those high yields that we talked about in emerging markets. That may be an area where investors could dabble or add some plus exposure, but that shouldn't be the core fixed income allocation within a diversified portfolio.
As you're thinking about some of the early catalysts or the drivers for portfolios going into 2025, what's at the top of your docket that you're keeping close tabs on and measuring up against for your own portfolio performance here as you kind of think about the changing of the administration? You also have the anticipation of what the Fed may do in 2025 as well.
Yeah, we're a very earnings-driven shop, and that's really where things start. Is what is generating the company's earnings, and are they growing that, and are they doing better than what is expected by the analysts in the community? So we're looking for those companies that are showing that in their evidence. An example of that would be Broadcom, which had been sort of motoring along a little bit, but then with their most recent report and the outlook for that over the next 3 years was considered to be very positive, and so the stock has really jumped. And that can happen with a number of names that also had been sort of laggards or underperforming. So that's what we're looking for, is to see those companies get that information where the company is showing that they can do it and are guiding higher.
So all this in mind, would love to get some top picks here as you're looking out into 2025.
Yeah, so one of the ones in the technology area is monolithic power, and that one has also had a little bit of a hiccup here, as there is some question as to whether or not one of their parts is going to be as broadly used by NVIDIA as people had thought. And if not, how bad is that? And do they have ways to make it up? We're owners of the stock, and we believe that they will be able to make that up, and that the cuts may not be as bad as feared. And at any rate, the news is already baked in. And so we think that the next piece of news is going to be more of a reaffirming than one that is saying, oh, there's more problems there.
Certainly. There's also two household names that jumped out to me that are high in favorability for you. And one of them is Spotify, of course, a household name there, as we just came off of everybody's Wrapped playlist that just got posted across social media feeds. And then additionally, another household name, Uber. Just break these down for us.
Sure. So we'll start with Spotify. And that is one of those companies that has just done so well and is trading near its all-time highs and has a fairly high valuation. But this is a company that is really still at the beginning stages of its penetration of its market. And the way that they break down their pricing tiers and the audience that they have, they're really able to segment what they do and to price it accordingly. And they still have pricing room left to be able to do that. So it's penetration, it's pricing, it's new ways of hitting the market, and the technology that they have gives them an advantage over other players. So that's why we like Spotify, even though it's continued to perform well. And with regard to Uber, that was a stock that was sort of a tale of two performance measures this year, coming out of the gate very strongly and doing well, and then getting cut significantly this year, really mostly on fears of the automated vehicle and the robo-taxi, and this will put them, at a severe disadvantage or actually out of business altogether. We think that one of the strongest things they have is their software and their technology and their logistics and their hold on the marketplace, and that they will be able to either do deals or otherwise be able to take advantage of the market and be a go-to company rather than one that goes out of business. And that stock is down significantly, so it's a good entry point for Uber.
Clearly, we have seen outperformance when it comes to General Motors. When you stack it up against some of their peers within the industry, making moves in terms of the cost-cutting space, you look at the guidance, they've been able to raise their profit guidance on a steady cadence here over this past year. I think the big question for investors is whether or not this momentum continues into 2025. What do you think?
Sure. Thanks for having me. We actually don't think this momentum is going to continue heading into next year for General Motors. In fact, last week we cut our rating from a hold to a sell on the stock with a 12-month price target of $45. We have a few concerns regarding General Motors. I think if you look back over the last 12 months, the earnings growth has really been EPS growth has been driven by the buybacks. They announced a big buyback last fall after the UAW strike was settled, and they continued to buy back more stock this year. So it's really been driven by share count reduction that has driven the EPS growth, not necessarily underlying net income growth. The second thing is Mary Barra talked about EV growth. One of our issues with General Motors is that they made a decision in 2020 to shun development of hybrid vehicles. As a result, they currently have no hybrid vehicles available in the marketplace. Hybrid vehicles are the fastest growing segment of the auto market in the US. And so while they've had some success with their EVs, we think the federal EV tax credit will be going away. That's going to really hurt their EV sales. And they've lost out on 4 years of development with hybrid vehicles. Now, earlier this year, they decided that they're going to start developing hybrid vehicles again, but we think it was a big strategic mistake. So we see an environment in 2025 where GM actually loses market share to some of their competitors.
Do you think that the pivot on Cruise and the ability to save on CapEx because of that decision could put a little bit of pressure on your call here, just because of the degree of cost cutting that's going to continue and how that frees them up for other innovation that you may not be pricing in?
Yeah, I mean, another one of our issues with General Motors is the credibility of management. If you look back as recently as last year, they said that the Cruise business they thought could generate $50 billion of annual revenue by 2030. And now just last week, they've decided to discontinue the Cruise robotaxi business. And so I think, looking back, I think that's a real black eye for management of the company, to be making those kinds of forecasts. Just an incredible $50 billion of annual revenue is incredible. And if you look back, they've spent about $10 billion on Cruise. And it's been a huge waste of capital, in our opinion. Now they're deciding to exit the robotaxi business altogether.
Yeah, but it looks like at least some of the strategy that they have laid out, at least over the last year, is resonating clearly with investors when you got a stock up just about 43%. Garrett, let's talk about another name that's obviously garners a lot of the attention within the industry, and that is Tesla. We've gotten more bullish calls out this week. Dan Ives over at Wedbush being one of those, just talking about the new market cap milestone that we could see here from Tesla in the new year. I'm not sure you're totally on board with this. What are some of your biggest concerns when it comes to Tesla in 2025?
No, so we are on board. We have a buy rating on the stock. We had been at a hold. We went to a buy the day after the election, and since then, the stock is up almost 90% in just a little over a month. It's been, about 6 weeks. It's been an incredible run for the stock. I think the stock is pricing in a much easier regulatory environment for autonomous driving. And we think Tesla has the best technology out there, and they're really going to be the biggest winner from that. We've heard the President-elect Trump transition team talk about how that's one of the number one priorities of the U.S. Department of Transportation is easing the regulatory framework to make autonomous vehicles a reality. And so that's really the future of Tesla. And, if they succeed in doing that, that unleashes a enormous market opportunity for Tesla. And, in the meantime, they continue to improve the full self-driving product. Version 13 just recently launched with significant improvements over the prior version. You're really seeing their efforts incorporating AI into their development has really improved the product over the last year or two. So we continue to like the stock.
Garrett, the reason why I said that you weren't really on board was when it comes to the first thing that you have in your prediction list is that it's going to fall short of his 2025 vehicle sales growth guidance. And not just fall short. You see volumes growing only 10 to 15%, which is about half as strong as the guidance. Why then are you not more concerned about that?
Yeah, so that's one of our predictions. The report we put out a couple weeks ago is that Tesla will fall short of this 2025 vehicle sales growth guidance of 20 to 30%. However, I think important caveat in that prediction is that if they continue to make progress towards getting approval for fully autonomous vehicles, that's really what's going to matter more, and we think investors will be forgiving if they do fall short of that guidance. We have seen in the past many times where Elon Musk, makes a prediction or is too aggressive on his timeline as far as when things will come to fruition for the company. But eventually he gets there. It's just not necessarily in the time frame that he originally said.
All right, Garrett, we got to leave it there. Thanks so much for joining us this morning.
Thank you.
A robust 2024 is stoking some fears of overstretched valuations in equities, but our next guest seeing some better market breadth in the coming months, driven in part by some strength that we could see in small and mid caps. Let's talk about that and more. We want to bring in Scott Helfstein. He's the Global X Senior Vice President and Head of Investment Strategy. Scott, it's great to have you here on set. We wanted to start with the small cap part of your call, just because it was one of the more interesting parts of the outlook here to us, just given some of the relative underperformance of the Russell 2000 that we've seen versus the S&P, obviously. Why are small caps ripe for outperformance at this stage?
Well, it's important to remember that small caps were a really important part of the success story of 2023 because they were investing. And they've sort of fallen off the cliff in 2024. So in 2023, small caps were spending about as much to reinvest in their business as the Mag 7. And now they're spending about half as much. We have an administration coming in that's talking about an America First policy and that's talking about deregulation. That helps to spur animal spirits. And so we think that small caps, which by the way, since June, are actually outperforming the large caps. So we're seeing this transition already, but we think they're poised to continue to invest. And that will, we believe, help to broaden out not just the market, but the economy and the participation so far.
How long-term is that call? Because if we take a look at the Russell 2000 over the last month, I believe it's up just about 2%. It's had obviously a huge run to the upside, but then it's come off of those highs. Is that a sign that this Trump enthusiasm is waning in small caps as we head to 2025? Is that about the Fed? And if that's the case, when can we expect to see a return to those gains in small caps?
Well, we're optimistic writ large about next year for 2025, partially for the investment story and partially for the return of manufacturing. But we do believe that there is a tremendous economic uncertainty out there. We've got questions about tariffs, taxes, and deregulation. And when you try and calculate the net effects of that, really what that means is there's a potentially broader set of general outcomes. So what seemed like a fairly clear pathway for the Fed is probably a little bit cloudier because tariffs raise prices, right? Takes money out of the private sector into the public sector. Tariffs return money from the public sector to the private sector, and deregulation spurs businesses. So you put all that into the pot, and what we tried to do is assess some of these flows. In the end, we think if the new administration comes in and they have a graduated response and implementation strategy, then that could work really well. But we're going to have to see as this all plays out.
Yeah, Scott, when it comes to one of the critical questions I loved here within your outlook was about valuation and what is necessary in order to sustain some of those valuations. Obviously, a lot of that coming down to higher profit margins. What is necessary in order for that scenario to play out?
So what is amazing is that the S&P has now, since the beginning of 2021, delivered 12% profit margins. That is absolutely remarkable. You go back to the 1950s, average profit margins were 6%. You accelerate into the 2010s, and they're 9%. So it took all that time to get 3%, and all of a sudden we've just tacked on another 3%. And we think that that's a story around automation, robotics, artificial intelligence, using digital technology to connect with consumers. So we really believe that that is an important driver. So what are we talking about for next year? Profit margins at 14%. Third quarter next year is forecasted to set an all-time record for profit margins. The other piece that we need is earnings stability. That's the part that we've been lacking because we've seen an economy that's been a little bit bumpy. It's been great in the sense that it has outperformed expectations, but it's been a little bit inconsistent. So if we get that earnings stability, we get those improved profit margins, we think there actually could be further multiple expansion along with the profit growth. That said, there are also a whole lot of themes tied to U.S. competitiveness that we think might even be more attractive than the general markets.
What are those themes?
So a few of them, for example, defense technology, given the challenges around the world. The focus on onshoring and manufacturing, I think, brings robotics, artificial intelligence, the entire complex data centers into focus. There's how we power that, energy independence being a top priority for this administration. So think about fossil fuel energy infrastructure, the increasing need for electrification, and I would say even nuclear power.
Can I follow on this just because energy independence, that came up this morning in the Bank of America Fund Manager Survey. They noticed allocation to commodities at the lowest level since June of 2017. Do you think investors are missing something there?
Well, I think that there is a push and pull in terms of the traditional energy market and the future needs. And so right now there's concerns around China. I think there's also a sense perhaps that given the geopolitical challenges around the world, energy prices are a little bit of a pivot point that might actually sort of push people in different directions with regards to issues around Russia and Iran. And so if we move that out and we think about the long-term trends, there's absolutely no question, whether it's electric vehicles, whether it's artificial intelligence and data centers, that we need more electricity. And that is going to be a global trend. And so that's one of the reasons, for example, why we really like the nuclear perspective. We really like the nuclear angle. And we're seeing mega cap tech companies actually move in that direction.
Liz, good to have you here with us. What are you expecting from the Fed as we head into 2025 on the decision and the tenor that they could cast?
Thanks. I think, as you said, the market's already discounting a 25 basis point cut. That's a quarter of a point tomorrow, widely expected, and I don't think there's going to be a surprise there. But going forward, that's what we're all really focused on. Where we start getting, a mix of outlooks is, will they cut again in January? And more we're thinking they're going to stay put. They're going to wait and see what the new administration does. And tomorrow we'll be looking for some clue of that in the comments from our Chairman Powell.
And so within that, what do you think that this market could hear from Fed Chair Powell and ultimately really try to get a sense of where we could see cadence cuts next year or where there could be a pause that the Fed might be mulling?
This Federal Reserve has really always focused on data. If we look at the comments time and time again by the different presidents, regional presidents of the Fed, as well as the Federal Open Market Committee, we hear them saying, we're going to be data driven, we're going to watch the data. So that's what I expect in the commentary tomorrow. But I think what we'll hear is something nuanced, like things are imbalanced right now. That's a very typical word to use, balance, in that report, and that they're going to be watching for signs that lean it either way. So I think we're going to hear that the current situation is in balance and they're going to be data-driven going into 2025.
Liz, even as we're thinking about 2025, you say that now is a good time to invest in domestic companies. Walk us into the thesis there.
Well, we're seeing just every way we turn, we're seeing increasing global weakness. This week out of Europe, really struggling GDP reports, negative from Germany. It looks like the continent is really struggling to find any growth at all, and we don't see a catalyst to change that going forward. They've been ahead of us in lowering their interest rates, and yet they're still struggling to find growth. When we turn to Asia, we know China is the same. There has been policy changes, but they haven't been significant enough, or they're not making a change in consumer spending and consumer demand. So as we look into 2025, what we're seeing is a global economy that's likely to be struggling, and the one bright spot is probably the United States.
What are the best profiles to really help investors identify companies that are positioned well to outlast any type of geopolitical conflict or even the exposure that some companies have versus others to other countries and selling into specific customers or corporate partnerships?
So what we look for across the board is certainly we're looking at what the domestic exposure is in terms of sales versus global. The vast majority of companies are global companies these days, but we're looking at where's that tilt? Is there more a tilt to domestic sales? Is their business more driven by trends in the United States? And then right now we're certainly looking for cash flows, and with the rate environment, we're looking at improving leverage or improving coverage of that leverage in the companies that we're focusing on.
So which are the companies? Give us some names. Who are your top picks going into the next year?
So one of the companies that fits all that is Hartford Financial Group, Financial Services Group. Most of their business is property and casualty, so this is entirely U.S. based. And even while we hear a lot that the insurance companies are struggling with all the catastrophes that keep roiling the United States, these companies are positioned well to get pricing, as many of us as consumers know, and that really is helping them maintain margins. It's a company at a very reasonable valuation right now in a very fully valued market. So one of our top picks, symbol HIG, is Hartford Financial Services Group.
Interesting. Disney also on your list. Walk us into that, especially as we know that the media landscape, and for Disney, they have a lot that has really been pressed upon them by activist campaigns over the past year, and now really even more so of a focus of how the direct-to-consumer entertainment business is going to fare going forward, what Disney has to do with the mix of the other assets that they have as well.
So well said, Brad. Disney has been struggling to bring out the value of its assets. We know that. This goes back a few years now. We came out of COVID with such a focus in media on streaming services, and I think what Disney is doing right is starting to change that narrative. We're looking at Disney and other streaming companies to hear how they're talking about the rest of their assets, and Disney in particular is reporting out, perfectly good growth in the streaming, but doing what it needs to do to bring out the value of all those other assets. We've had a stock that's really done nothing all year till a recent pop on the latest earnings. Now in theaters, we're seeing Moana, one of its animated features, hitting all-time records, bringing people back to the movie theaters. And what I think we're going to see in 2025 is Disney starting to pull better on its oar in every one of its assets. There's never been a question that the company has tremendous value in those assets, but the last couple of years they've struggled to bring that value to investors. And little by little, I think we're seeing that tide turn.
All right, we're going to be watching closely. We'll also see what the reception looks like for Bluey and that partnership that's coming forward as well here. Liz, thanks so much for taking the time.
Thank you.
According to a news survey from KPMG, this year we saw just $1.8 trillion in total deals. That was below the pre-COVID average. But according to this new data, deal makers are optimistic about 2025. Joining me now in studio, we've got Carol Stryker, KPMG Head of Deal Advisory and Strategy. Carol, great to have you on set with us this morning. So talk to me about what this survey tells us about how deals are looking heading into the Trump administration. It feels like we're already starting to see huge M&A Mondays popping up, and he's not even in office yet. So I anticipate a lot of optimism.
Yeah, absolutely. As we look at the survey results and what we're seeing with our clients, a lot of optimism from the deal makers. We did a study, our annual survey just came out. We did it right after the election so that we'd be able to get that sentiment of about 300 deal makers, all with companies over $1 billion of sales, and the sentiment was just real positive, saying that they were looking at more deals than they were. 90% of them were looking at more deals than they were a year ago, 83% more than they were just 6 months ago. So real positive optimism coming into this new year.
And I'm fascinated about sort of the driving factors behind that optimism. And one thing that really stood out to me is that people are a little bit less obsessed with getting the highest possible value in the deal. It seems like, I felt like before companies were seeing NVIDIA and then thinking, okay, well, I can get, trillions of dollars for my company. And I'm obviously exaggerating, but it seems like valuations are cooling as well.
Yeah, well, I think it's an alignment of the valuations, right? Like, I think that there were people who were thinking in the height of the valuations in 2021 that sellers were like, we're not going to sell unless we get that valuation. Yeah. And so there was a misalignment, and we saw that even in the data that from the survey is that is still an impediment for doing deals, that misalignment of valuations, but it's come down significantly. And then what we're seeing also with the deals that we're working on is that we're coming together more alignment around the valuation, which is an important part to obviously getting deals done.
So pricing is just more accurate now, it seems.
Yeah, and I think that there's an alignment in regards to sellers' expectations and buyers' willingness to pay the price that the sellers are looking at. So that just alignment of, interest rates are coming down, the cost of capital is lower. So I think that helps with the buyers' evaluation as well. So I think that alignment of getting the prices to a place where they can actually transact.
Right. And it's interesting you bring up interest rates because we do have that key Fed meeting today, expected to cut, but the path forward for the Fed is a little bit more murky. If we do have a higher for longer environment, how much cold water does that throw on any of the optimism from this survey?
Yeah, absolutely. So, interest rates are a key element of doing deals and getting deals done. So if that, I think the cool water is more from a perspective if they start to go up. There's concern around inflationary things that might happen in the new administration. And so if that happens and interest rates go up, I think that's a lot more of the cold water threat that I would think of. I think in the current environment with interest rates, they've had 3/4 of a point cut this year so far. Today, like you said, is a big day to see if they're going to. Our economist is thinking it's going to come down 1/4 point. We're also still projecting that it's going to come down another 3/4 of a point next year. And so with interest rates being a key element of helping deals to be done, it is an important factor for the optimism that we're seeing. I think if it doesn't, and if it just stays flat, I think that we can still price deals, and there is a ton of other things that are working. When we look at the survey results, the number one issue is around growth. It's how do I help with the growth of my business, and M&A is a key component of helping that happen. And there is an enormous amount of dry powder. There's a lot of cash that needs to be put to work. So I think all of those aspects will help to continue to spur that M&A activity this next year.
Right, still nearly $7 trillion on the sidelines. You got to put that money to use at some point. Another fascinating part of the survey that I want to end with here is the number of deals that sort of utilize AI along the way, especially in private equity, just an overwhelming majority of deal makers utilizing AI throughout the process. How unique is that to you compared to previous survey results?
Yeah, so we definitely saw an increase around 50% last year talking about using AI and doing deals, and then up to 77% using AI in deals today. And the thing that I also found interesting is that it's throughout the deal process. So from the beginning stages of sourcing the deal to then transacting, doing integration, but also around the value creation. Actually, the value creation piece was within the survey where we saw it most. And then that's what we're seeing as well when we're working with our clients at KPMG, with our clients that are doing deals. AI is absolutely being utilized. And to your point, it is more being used within the private equity community than it is the corporates, but both are still using AI and seeing the value that it brings and helping them transact and doing smart deals. And then when they do the deals, creating value from those deals.
And increasing productivity along the way.
Absolutely.
It sounds like. Carol, thank you so much for joining us and bringing us this survey result. Really appreciate it. Thank you so much.
Thank you for having me.
Of course.
Morningstar found a record 55 mutual funds were converted into ETFs this year. In 2025, Bank of America expects an additional $3 billion in conversions, and Cerulli Associates expects ETFs to hold more assets than mutual funds by 2026. For more, I want to bring in Todd Rosenbluth, who is the TMX VettaFi head of research for this week's ETF report brought to you by Invesco QQQ. Todd, good to have you here in studio.
Great to be here.
Absolutely. Let's talk about this a little bit. We're capping off a record year of ETF inflows. What do you think has really driven that?
So you're right. So $1 trillion has gone into ETFs this year. We've seen demand for actively managed ETFs. We've seen demand for fixed income ETFs. We had the first ever crypto ETFs, Bitcoin ETFs that were quite popular. ETFs are increasingly where advisors and investors are investing, how they're investing. It's the way that their focus is. But you mentioned earlier a number of trends that are happening. Mutual fund to ETF conversions, mutual fund providers that are now launching ETFs in the space. That's a great area to focus on.
Why do you think that's happening?
Well, asset managers are going where the investors are, and we're hearing that advisors, we're seeing the data, but we're seeing that advisors, according to VettaFi, are increasingly turning to ETFs. So we have a firm like Neuberger Berman that has expanded its product lineup. They launched a new product today. They've rolled out a suite of products throughout the year. T. Rowe Price is another firm that's had success bringing some of their best and brightest into the ETF world from the mutual fund world. It's just exciting. This is where investors are focused. It's where the asset managers are focused too.
What can we extrapolate about the flows into ETFs this year to really give us a sense of animal spirits in the market right now?
Well, we're seeing optimism towards equities. We've seen greater bullishness. We at VettaFi hosted an event last week where we asked investors and advisors where they were leaning heading to 2025, and almost 75% were bullish on equities as opposed to bearish on equities. Now, we gave them two choices. The market's up roughly 30%. But we're seeing Vanguard 500, $100 billion alone has gone into that ETF. IVV, second most popular ETF this year. We've seen core S&P 500 products. But you mentioned animal spirits. There's, of course, leveraged ETFs that are tied to single securities. We've seen options-based strategies. It's a great time in the ETF marketplace.
We talk about some of the most overcrowded trades right now in the market, and it has been long Mag 7 to this juncture that continues to hold strong and really outpace. But if you are an investor looking for the broadening to take effect into other sectors and areas of the market, what are the ways to play that from an ETF perspective?
So small caps is a great opportunity for investors to participate. And there's some actively managed products. I was mentioning Neuberger Berman earlier. They have a small and mid cap product, NBSM, that's new this year, again, bringing some of their best ideas. T. Rowe Price has a ticker TMSL, T-Missile, as I like to say out loud, in terms of saying tickers together. That has been gathering assets. We've seen actively managed small cap ETFs, small and mid cap ETFs start to gain traction. That's a great way to see the market broadening out.
Yeah, absolutely. Just lastly, while we have you here, and you're thinking about some of the generational approaches that we've seen over the course of this year and really flocking to ETFs, and what is anticipated as we get even more new market participants and investors coming on board. How is that anticipated to impact the ETF landscape furthermore?
So newer entrants into the ETF, new entrants being participants that are buying ETFs, they're likely to start with something simple and broadly diversified like the S&P 500, and then gravitate towards something that takes on, that can tilt to their portfolio. So we've seen some thematic-oriented ETFs. Global X has had success this year with some artificial intelligence ETFs, AIQ. We were talking about AI earlier in some of the leading stocks. That's a great way that we're seeing investors tilt their portfolio towards some of the growth parts of the marketplace.
Trump is moving back into the White House. That has potential different ripple effects for the energy sector. One bet, of course, Dan, investors have been making is that this is going to mean a friendlier regulatory backdrop. I'm just wondering, against that, Dan, would you be expecting to see more M&A, more deal making in the energy sector over the next couple of years?
Yeah, great question, Josh. Glad to be here. Without a doubt, the Trump administration is going to be friendlier to the conventional oil and gas sector. As Inez just mentioned, maybe prices are lower. Consolidation, it's been very active with companies buying each other in 23 and 24. We think more of the same in 25, particularly with a friendlier FTC. And so I think you should expect companies looking at trying to get bigger, trying to capture the attention of investors. And really, this is all happening at pretty inexpensive valuations, 3, 4, 5 times cash flows. So expect to see more deals as we go into 2025.
And Dan, when you take a look at energy stocks, the majority of them are still cheap at these levels. So is now the buying opportunity then? And I guess so, what is that common thread that investors should be looking for when they're trying to identify the best plays in the space?
Yeah, when we look at 25, I think potentially the risk here is that you have very inexpensive stocks that are generating, high free cash flow yields, and will investors care? It was the same story in 24. The sector's underperformed pretty dramatically, but up a lot less than the market. As we go into 25, I think you have to be a stock picker in the face of an okay but not great oil and gas price environment. And so I think you look for companies that have a stock-specific story.
And what would be some examples of that, Dan?
Yeah, when we look at the space, we like things like Diamondback Energy, which is a Permian producer that made a really big acquisition in 2024. They're going to be taking out costs. The Permian Basin is a low-cost area. They are the crown jewel. Eventually, they'll be a target. We look at names like Conoco that's underperformed this year, that's very inexpensive. Another name in clean energy is GE Vernova, a spin-out from GE. That stock, although it's not cheap, really has tailwinds in terms of where spending's happening. So those are stock-specific stories that don't necessarily need higher oil or gas prices to work.
I was going to say, Dan, what's the catalyst, though, that's necessary in order to see a broader turnaround within the sector and not so stock-specific when it comes to some of those outperformers?
Yeah, when we look at what does it take, we either need to see much higher commodity prices, which is probably something related to a Middle East conflict and a true disruption of oil supply. I'd put a relatively low probability on that, but who knows? It's a geopolitical wild card. And then the other would be some sort of resurgence of inflation that pulls money away from the kind of current high flyers and more toward value and potentially inflation impacted stocks. So you need the current market environment to change. I don't know if we're going to get that. And so that goes back to the stock picking. Beta may work. Alpha hopefully certainly works.
Dan, one other Trump theme I just want your 2 cents on. It has become, and you know this, a Republican mantra, right? Drill, baby, drill. Do you believe we're going to see a pickup in U.S. production? We have had other, smart folks like yourself, Dan, who know this sector very well, who don't think we're going to see that, but I'm interested to get your take.
Yeah, no chance for drill, baby, drill. Oil was 120 in the Biden administration. He asked for drill, baby, drill, and the industry didn't do it. We now have lower prices, maybe potentially weaker supply-demand fundamentals. Drill, baby, drill doesn't work for the industry. And so I think it's unlikely to see an uptick in drilling activity. Supply grows a little bit because of efficiencies and drilling in the best basins, but I don't think there's a very high probability at all that we're going to see a meaningful uptick in activity in 2025.
Dan, sticking with Trump policies and more so what he has said about the EV space, obviously he wants to repeal some of the benefits. We talked about the fact that he has said that it is important, obviously, for the future, but doesn't seem to be too concerned just in terms of motivating Americans to buy EVs right now. Is that enough for you to stay on the sidelines when it comes to some of these EV makers?
Yeah, the EV OEMs and potentially the charging companies, it's a great idea whose time is still yet to come. It's growing, but growing more slowly than expected. EVs are still expensive relative to gasoline-powered cars, and the subsidies are likely to get removed, supported, by the way, by Elon Musk, as he helps President Trump. And so the EV makers, Tesla is very expensive. Rivian looks way too expensive to me, given all the money they're going to have to spend. So I'm on the sidelines with the EV makers.
All right, that's EV makers. Another theme I want your take on, Dan, all things nuclear. As you know, lots of interest, lots of excitement. Do you want to own any of those names right here, Dan?
Yeah, I do, but not now. When I think about nuke, it is the best long-term energy story out there, but it is very long-term. Think 20, 30 plus. And so there's been a lot of hype. All of the hyperscalers have been announcing deals with the nuclear companies, and those stocks are up a lot this year, too much, most likely. The reality is it is 5 to 8 years before the real revenues start to flow from those contracts, assuming the technology plays out. And so nuclear is a great theme that's a little too expensive right now from my perspective.
We think going into 2025, we still want to be leaning into risk here. We think the pullback in the tech sector in particular probably presents opportunities here. We think there's still a lot of growth to come. We think there is broadening, especially among tech companies that help other companies become more efficient and improve productivity using some of those AI tools in ways that benefit companies. We don't think it's just going to be about the mega cap tech names. Those will do well, but we do think it's going to broaden to a tech space that includes a lot of other tech companies, mid caps as well, that benefit from these technology trends and AI implementation.
I want to get your take on some data from Bloomberg Intelligence indicating analysts are still expecting 23% earnings growth for 2024. Obviously, we're still waiting on that final quarter of earnings. That has only happened after recessions or in 2018 after tax cut regulation from the Trump administration the first time around. How can tech hit those levels of expectations in 2025?
Well, expectations are reasonably high, and we think that is the big question, whether or not tech does reach those expectations are currently being priced in, because if it does, valuations are not extreme or even stretched right here. That would look quite reasonable if those expectations for 2025 are met. How can it hit those? We think the big thing is an expansion of profit margins, and we do think we're in the beginning stages of a multi-year productivity cycle, and that productivity is going to hinge on the implementation and rollout of these new technologies. So we are pretty optimistic that this can actually happen. Of course, not every company is going to be a winner in the scenario, but if we think in the big picture, the world is going more tech, and tech is being implemented more and more and becoming more of everyone's daily lives. And that trend means that there are going to be a lot of companies that benefit from it.
In the past couple of years, we have seen rising yields at times provide a stumbling block for large cap tech, for the markets overall as well. So I'm curious how high you think yields could get. We've obviously been seeing them move up, and whether, again, that's going to provide a little bit of friction.
Yeah, we think there are a few things that are in play in terms of how high yield, long-term yield, say the 10-year treasury yield could go. We think there's probably some upward drift for the next few weeks here, but there's, we think, somewhat of a lid on that will be dependent then upon what happens with tariff policy with the incoming administration. We think absent any big shifts in the tariff policy, that's a big if, we will grant you that. But absent any big shifts in tariff policy, perhaps the 10-year yield could drift up to around 4.75, but we don't think it would go much further than that until we see what tariff policy looks like. If there are some more aggressive actions that are taken right out of the gates with tariff policy, yeah, we could get to 5% on the 10-year treasury yield. We don't think that's far-fetched at all. And that would probably cause a bit of a pullback or hiccup in the markets. But we actually think over time, and even within a relatively short period of time, maybe a month or so, the markets will be able to digest that level, stabilize that level, and then refocus on earnings. I think the difficulty and damage would actually come if that 10-year treasury yield gets above 5.5% and stays above 5.5%. That's where the difficulties, I think, would start to set in a more meaningful way.
If we do see treasuries hitting above 5.5% on the 10-year in particular, what does that tell us about how the market is viewing this round of inflation and whether or not it could be a problem for even these large cap tech names heading into 2025?
Well, it would signal something along the lines of stickier inflation, perhaps concerns that tariff policy was going to stoke that even further. I think that was probably one of the underlying drivers of that University of Michigan sentiment survey that came out relating to inflation. And what does that mean for valuations, for example? I think people then start looking at the trade-offs between investing in stocks versus putting money in bonds, and there's a little bit more pressure or impetus to see that flow go more aggressively into fixed income until you reach a new equilibrium, and that would probably result in a pullback in the marketplace broadly, including tech. But again, we're not at levels, even if we get to 5%, 5.5% on the 10-year treasury yield, we are not at levels that we have not experienced before. If you go back to 1995, short-term rates were at 7%, and the 10-year treasury was about 7.75%. The big question is what happens with productivity, what happens with growth, and that's a bigger driver than than the yields once the yields stabilize. It is important that the yields stabilize and allow for the economy to recalibrate.
The average savings account interest rate is just over 0.5% according to Bankrate. That jumps to 4.5% for high yield accounts, but after the latest Fed rate cut, even that could decline. So if you're unsure about how much cash to have on hand, Andrew Kajetsky, Vanguard head of brokerage and investments, is here to help. So Andrew, let's start with that rate decision from the Fed earlier this week. Another 25 basis point cut, but less easing expected next year. So how is all of that going to impact cash?
Yeah, thanks for having me, Alexandra. You know, whenever there's a change in the Fed rate cut, you know, like occurred earlier this week, we always encourage investors to take a step back, look at where they are holding their cash savings. You know, is it in an account that really meets their needs, particularly to help them reach their, you know, their savings goals? You know, there are far too many Americans these days that are not getting the returns that they deserve on their hard-earned savings. You know, this is because a lot of that money is sitting in those lower yielding, you know, traditional bank savings accounts that you just talked about. You know, that average savings rate is just 45 basis points. You know, but the good news that is out there, that there are higher yielding offers out there. You know, for example, Vanguard. You know, we've been offering, you know, industry leading money market funds for decades, but we also recently entered the savings arena. We just launched the Vanguard Cash Plus account. It's currently yielding 3.9%. That's 8 times that national average that you quoted.
Mm-hmm. And we seem to have a pretty jittery market right now after that sell-off earlier this week. How does that feed into the calculus of how much cash to hold versus how much cash to invest in stocks?
Yeah, this is a common question that we get from investors, and it's all about finding the right balance, because you certainly need to make sure that you have enough cash on hand, right? If you don't have enough cash on hand, you risk having to, you know, dip into your longer term investments like your retirement funds, which can be very detrimental to your financial health. You know, at the same time too, you want to make sure you're not holding too much cash, right? The more cash that you hold, the less diversified your overall portfolio is, which is going to make it harder for you to achieve your long-term outcomes. So again, it's all about finding that right balance. And you want to put cash towards your shorter term savings goals and make sure you're putting your money to work in your longer term investment goals, like saving for retirement.
And when you talk about that balance, is there a certain percentage of your income that you should reserve for just cash holdings? And if so, how do you appropriately determine that amount?
Yeah, so you know what Vanguard would recommend, this is all about building first an emergency savings fund, right? Vanguard would recommend that first start off saving at least $2,000, right? Or about half a month's worth of your income. This can build up a nice reserve just in case, you know, there is some short-term spending or cash needs that you have. From there, you can start building up a more proper contingency reserve, somewhere in between, you know, 3 to 6 months worth of, you know, living expenses. And again, beyond that, you want to be really thoughtful of what is your goal? What are you saving for, so that you can start putting that money to work either in a short-term savings account or into a longer-term investment account.
And looking ahead, there are a lot of uncertainties between what the Fed ultimately decides to do with interest rates, the incoming Trump administration. Are you hearing concerns from clients to hold on to more cash until we have a better idea of the future?
You know, what we always stress is, you know, to make sure that you control what you focus what you can control on. You know, and you know what we do is you say, you know, start with what is your goal, and then build a plan around that. When you have a goal and a strong plan around that, it's easier to stay the course and, you know, filter out the noise that's coming from, you know, volatile markets or uncertainty in DC.
Wondering how AI infrastructure deployments will shape up next year? Our next guest lays out 5 questions that folks should be asking. Joining us now to discuss, we've got Antoine Chekabin, who is the New Street Research Technology Infrastructure Analyst. And we're not going to run through all 5 questions off the top, but what is the top question that people should be asking about AI in 2025?
Thanks a lot, Brian and Brad, for having me. I would say the top question is about AI scaling. We're now about to enter, you know, the 3rd year of the AI investment cycle that started in 2023. And as you know, a number of concerns that have emerged in recent months regarding the sustainability of AI scaling, or in other words, the ability to increase the performance of generative AI models by just throwing more compute at them. And on that front, well, I would say that the recent developments have clearly shown that, on the contrary, AI progress is very far from over, and is, if anything, accelerating. With the family of O models, so first O1 that was released in September and now O3, OpenAI has made a very significant leap forward towards AGI, with even the most demanding benchmarks acknowledging a genuine breakthrough in AI adaptability and generalization of generative AI models. So to put it simply, these models combine deep learning with the ability to create a new program when facing an unknown task. So in other words, the model likely develops a very large number of possible chains of thoughts to execute a task, organized as a tree of change steps, and evaluates which trajectory is best. So in some ways, this is actually analogous to what we humans do when we plan a sequence of steps to accomplish complex tasks. And so the performance of these models clearly shows that AI systems will be able to address at least human level and probably suprahuman level tasks in the next few years. And that, of course, is going to drive adoption and fuel continued very strong demand for AI infrastructure spending in coming years.
Antoine, every time one of our viewers or users hears AI, they immediately go right to NVIDIA. Now, good thing for us, you do have coverage and you do follow NVIDIA. Do you think the sell-off over the past month in NVIDIA is overdone based on the research you have done on AI infrastructure?
Yes, thanks for the follow-up. So I think it is overdone indeed, because as you know, I think that the key concern here that you're talking about is that even if you do believe that spending on AI infrastructure is going to go through the roof, some have voiced concerns regarding the ramp of ASICs. You know, it's those in-house chip programs that hyperscalers have, potentially waiting on demand for NVIDIA GPUs. But what I would say here is that reality is that only one or two companies maybe have successfully deployed AI ASICs at scale today. That is, of course, Google with the TPU and Amazon with like a number of inferential and Trainium chips. But by definition, ASICs are application specific, which means they trade off flexibility for performance. And on top of that, they like an ecosystem. As you know, NVIDIA has a very strong ecosystem, you know, not just the CUDA software stack, but people know how to use their chips. Today, if you go on Hugging Face and you download a model, you can run it very, very quickly on an NVIDIA chip. It takes you much longer if you want to do that on ASICs. And so the result here is that we estimate that even Google, who has that in-house program ramped at scale, still spends more on GPUs today than ASICs. So GPUs remain dominant for public cloud, pretty heavy workloads and workloads that require high programmability. And so we do expect NVIDIA to remain dominant even if these in-house programs ramp. So we do think that, as I mentioned earlier, on one hand, you have AI infrastructure spending that is going through the roof. On the other hand, you have NVIDIA that is going to remain dominant in AI infrastructure. So we do think that this sell-off is definitely overdone.
Yeah, it's interesting you mentioned Hugging Face. We've had their CEO and founder, Clem DeLong, on a few times here on Yahoo Finance, kind enough to give us some of his time. So good to hear him. And of course, the team that is putting the work out there really get recognized here. You think about some of the other, the spread of where investors can be looking at the AI theme more broadly and anticipate for there to be deeper value. Is it within the applications that are built out by existing social media companies? Is it by the agents that we hear some of the largest cloud companies talking about? What is that next shoe to really get worn in by some of the investors here?
So, I mean, as you know, the space we cover is specifically infrastructure. But so what I would say on that front is that we're moving from 100,000 chips today in the largest clusters to 1 million chips. That's around the corner. And as I mentioned, like these AI scaling laws increasing that are still completely valid increase our level of conviction that we're going to go there. But another angle that you can take to increase your level of conviction is simply look at the plans of the usual suspects. First, you have like a handful of companies that are reportedly planning to roll out clusters of 1 million chips in 2027. Second, you have OpenAI, who is reportedly planning to increase the amount of money it spends on training compute by an order of magnitude by the end of the decade. So if you're moving from 100,000 chips to 1 million chips, well, on the AI infrastructure front, what I would say Of course, you have NVIDIA, as we discussed earlier, but you also have Broadcom, which is the company that is leading today in ASICs and also in networking to interconnect this 1 million cluster with very, very dense networking to make it act as a single computer so that we can train these very, very large models, these very complex models with the chain of thought capabilities that we discussed earlier. So I would say NVIDIA, Broadcom. Of course, you have AMD as well. That's very well positioned. The only alternative to NVIDIA for GPUs. They don't sell. So you have Broadcom in ASICs, you have NVIDIA in GPUs. AMD sells also GPUs. It's very hard to design a GPU, to design a chip that's as flexible as a GPU. And AMD is the only alternative to NVIDIA there. And then I would say in the broader like tech infrastructure landscape, you have, of course, memory. We like Micron. You have TSMC. And of course, I mean, there are dozens of names, but those are the ones that I would say we prefer in the tech infrastructure space.
New Street Research Technology Infrastructure Analyst Antoine Chakaban. Good to see you. Happy holidays. Talk to you soon. 2024 saw the Federal Reserve cut rates for the first time in 4 years. Policymakers are striking more hawkish forward guidance with its recent rate cut. Central Bank looking to move cautiously as it assesses inflation and policy uncertainty under incoming President Trump. Meanwhile, slightly more hawkish Fed presidents are set to become voting members in the FOMC as well. Brad, this is really all top of mind here following a chat we just had on opening bid with Mary Daly, San Francisco Fed president. I thought what she said about policy being recalibrated was pretty interesting. Here's what she said.
So I see the recalibration period now as completed. We are back to the time when we can make our decisions more slowly, data dependent, using the data to affect the incoming forecast, and determine how many rate cuts we'll ultimately do next year. We'll have to be agile and data dependent.
And Brad, I didn't want to tell President Daly this, but my read was this, that maybe we do get a rate hike next year. I don't want to say that to her on or off camera, but this is like my brain processing, and just the fact they can't rule out a rate hike because where inflation is right now, it borders on alarming. I mean, this is a Fed that really tried to stomp out inflation. They still have not gotten the job done.
Yeah, it's interesting. And even listening to that soundbite where she was mentioning seeing the recalibration period now as completed here, that could place even more emphasis on other elements of how the Fed can operate. And I'm going to try and make the balance sheet sexy for some reason.
Please make it sexy.
Because it's the only thing that I can logically think that could see a little bit more undulation in the coming year here. And why does it matter here for the balance sheet? Of course, this is the ability essentially for the Fed to hold U.S. Treasury, agency debt. They also hold mortgage-backed securities. And so basically, this helps them offset some of the other elements of the policy decisions that they're making. And here's what you need to know. If there's anything that you remember about what the past few years have looked like, from May 2022 to November 2024, the Fed's balance sheet declined by $2 trillion from $8.9 trillion to $6.9 trillion. They're essentially letting bonds mature and then not selling them into the market. That's one of the only other levers, absent of any severe rate cuts or cadenced rate cuts that we see, that they could possibly pull in 2025 as well here.
Yeah, of course, this is all very important. You have a lot of investors that have bid up Mag 7 names under the thought that we get more rate cuts next year. This lifts the profit margins of these companies. And that's why we saw a lot of these stocks blast. I will contend, though, Brad, while rates are important, the direction of rates are important, what's more important for these Mag 7 names is the rate of growth. How fast is the AI infrastructure being built out? I understand the first instinct is to blame the Fed for everything and every time the market goes down, especially on big down days. But its earnings growth still matters. And I think as long as AI infrastructure is being built out in this country, you will see that Mag 7 trade come back.
All right, we're going to be watching closely for that, as investors will be. And they're considering the path of interest rates next year following the Fed's hawkish pivot, a cloud of concern hanging overhead in what's been a banner year for stocks. FedWatch Advisors founder and chief investment officer Ben Emmons joins us now with more. Good friend of the show. Ben, great to see you here. First and foremost, as you think about and correlate the Fed's activity and the anticipation going into 2025 with some of the largest market themes that have prevailed during 2024, how do you see that continuing to shape out and the overflow as we get into next year?
Morning, Brad. Yeah, it's a great question because, we're coming off a period of, like you said, a banner year. Right? We feel really good about the economy. We're good about the markets. Volatility is relatively contained. And as much as this Fed has made this transition now from the ending the calibration, as Daly said, to a new phase, as Powell said, we seem to be pretty in control of what's going on. And yet we're dealing with significant uncertainty ahead of us, right? We see a lot of new announcements coming through from the Trump administration. And although that's all pro-growth, there's also a lot of challenge there. I mean, you just take the news of the Panama Canal in by itself. I think that's very significant, or what's going to happen perhaps with Ukraine. So think of those type of forces in the background that have shaped markets so much over the last few years. An ending of the Ukraine war and the change of the Panama Canal could actually, in my view, infuse the economy here, specifically lower gas prices and more investment, into the U.S. economy. So I do think it's a bullish outlook for the U.S. economy. We could maybe even reach 5% GDP, but it will not go without the volatility. I do think we're going to get average higher volatility next year, simply because we do have a lot more policy uncertainty that we dealt with this year.
Ben, good to see you as always. 5% GDP. That sounds like a boom. That sounds like an environment that is going to sow the seeds of even more inflation. The Fed raises rates. Tell me I'm wrong.
You're not wrong that way, Brad. But I do think that it is the idea that the economy re-accelerating. That's already been happening in the past fall with the incentives, as Trump talks about when he was at New York Stock Exchange. And the word incentive, I think, is really important. That drives that growth rate. You're right, there's no free lunch. It will be with higher inflation. Inflation is stickier already because of the service sector, and goods inflation will be slowly reversing out of deflation into potentially again becoming inflationary. So I do think, to your point, it will be somewhat higher inflation environment, but leads this Fed at least to be on hold for longer in the initial stage. Whether a rate hike or hikes will happen, I think that's still far out. But higher for longer, as in on hold for longer, I think is quite likely for this Fed.
You, in your notes to us, mentioned that the market is looking like a casino in 2025. As you are thinking about that, the house always wins in a casino, we should also mention here. And so perhaps there's a different way that you're thinking about playing this. But, what are the top games that I would be apt to step up to the table for the market casino in 2025?
Yeah, good point, Brad. Because you enter a casino, you're gonna lose.
You took my headline, Ben. I wanted to ask you that. Go ahead. I just had to get off my chest. Go ahead.
Yeah, exactly. So you look to lose, but this idea of that we're seeing gambling in the markets appear, as the Wall Street Journal sort of nicely described, as well as in retail traders. But think about a bigger picture. People are really geared up for this AI investment cycle. There's data out from Goldman Sachs showing a huge investment boom ahead of us. In addition to what this Trump administration is planning to do with reshoring, back on shore investment, I think that infuses the speculation and makes it then more casino-like type markets. And that's the issue here, right? The dips get bought really quick, as you saw on Friday, and including today. And as that makes a shallower dip market, acceleration of getting to a new high will pick up. I think this is where the tension will come in. If this Fed has to stay on hold longer because its GDP growth is going to go to 5%, the casino risk increases significantly for markets. I think that's a possibility next year.
Ben, as you look back on the past year, what is the one thing that has surprised you about markets, and what is one surprise you think might take form next year?
Well, for one, we were surprised again by this economy not going slower than people thought it would be. I also thought that it was the election in itself that people thought was a very big event, and uncertainty actually turned out to be a big risk-on event. People embracing the idea that we're going to go to a different direction with this economy, and that there's a lot of confidence about it. And I think that's surprising given all the negative press that it's gotten. And so I think this is for next year very important. I mean, the NFIB survey showed this huge change in perception about the economy. If that's true, it's going to be more across the nation of people embracing risk-taking. And as we talked about casino risk, but also the risk-taking in the economy, I think that's key next year. If that continues, that animal spirits idea, I do stick with my view that is going to be a 5% economy.
It's time for today's strategy session as well. And our next guest has some interesting thoughts about where equities are going in 2025. Joining us now, we've got Eric Byrich, Sound Income Strategies Co-Chief Investment Officer. Eric, great to have you here with us. As we just laid out how this year has really transpired, your expectations and top plays going into 2025.
Well, great. Thanks for having me. It's good to be here. Yeah, my perspective is a little different than some of the narrative that we've seen. And basically, I think the market is set for a rotation. We've been waiting for it for a while. It's been led by the mega cap technology names or even some of the drug stocks and the GLP-1 data. But as their growth rates slow and their valuation multiples look more stark, we expect them to continue to retreat in a sawtooth fashion. And some of the value names that have really underperformed over the last 2 years to start to rise because their relative growth rates look comparable and their valuation multiples in many cases are a third of that of the market. So that's basically what we're looking forward to. But if you look at the growth rates in the S&P over even the current year, it's actually been negative growth if you take out the Mag 7 names. And even prospectively with the Mag 7 names slowing, the growth rate going forward, which some have in the double digits, is really hinged upon everything else coming back. So that's a little bit of a difference. And another difference is you guys were really negative on the Fed earlier in your program, and you had some guests talking about it and people talking about the Fed possibly raising rates. I don't think that's the case. Certainly, if you listen to Greenspan's testimony if you listen to Powell's testimony last week.
Well, if Greenspan was still the Fed chief, Eric, I'd be bullish on the Fed. I mean, that guy just cut rates and forever and sowed the seeds of a housing bust.
Dated myself. When Powell spoke last week, he was very clear. He wanted to be very balanced. He didn't, when he was asked specifically if they were going to raise rates, he said he doubted it. And I doubt it as well. If you look at the growth rates across the industries, I'll tell you about those in a second if you want. It's been slowing down pretty much across the board, positive earnings revisions. And if it wasn't for housing being stubborn, inflation would be substantially lower. And it's a 40% factor in the inflation measured in CPI, and it's such a big weight. And one of the reasons why it's up is because the biggest factor in housing is typically interest rates, and the Fed has been creating inflation money and inflation and interest rates. So as rates come down, you're going to see housing inflation come down as well.
Eric, Eric, let me just hop in here real quick. I like in your notes that you called out or tried to define what the average stock is in a market that's still pretty bulled up. And I hear what you're saying on Pfizer. I mean, the valuation multiples, P multiple of under 9 times forward earnings for a Pfizer. I mean, that sticks out. Do you think next year will be the year of the value investor?
I think the value investor will come back next year. There's two arguments for value stocks. One is the mathematical duration argument. And the mathematical duration argument basically says that value stocks do better when interest rates are higher typically. And that's a bond manager's argument. And that's actually going against value. But what's going to help value more is the abject extremes that we've had. So you have the market itself on sort of a PE basis. It's defined by the S&P 500, now trading at almost 25 times forward earnings. The average stock on a forward basis is trading at more like 18 times forward earnings. And that includes the MAG names. If you take those out, it's more like 16 times earnings, which is normal for the market. So there's a big divergence in what people are paying for these high growth names. And they're paying for them because they're scarce. Well, as the rest of the market starts to grow more and their growth rates slow, it's just going to be a shifting away from the more expensive names, which are still great companies and they have excellent free cash flow. And I'm not knocking them fundamentally. I'm just saying the price has gotten too high. And other things that have had more challenged fundamentals are going to start to look a little more stable and do better. So in the case of Pfizer, we talked about that. I've got a whole bunch of stocks that are under 10 times earnings. Pfizer is one of them, but the earnings growth rate of Pfizer is lower.
Yeah.
It's in the low single digits now, and that's before you take into consideration the RFK pressures on healthcare and the anxiety, which has created a depression, which is usually an opportunity. Usually, we've talked about this on your show before, valuations are a pendulum. They go too far in both directions.
Right.
And when people get scared, the sentiment gets overly negative. So it creates an opportunity for a sentiment reversal.
So Eric, with all of this in mind, is there one value investor's North Star that you would be pointing to right now?
The value investor's North Star, you mean besides Warren Buffett? No, and he's been pooling cash, which is a negative thing. But no, I don't know that there's a North Star. What we look for are companies that are cheap with temporary problems that can be resolved. Things are always expensive for reasons. We like buy things that are cheap for reasons that we think are temporary or not good reasons at all, like, technical oversells and things like that. There are good reasons to be negative on most of the value stocks that we buy, but we think there are better reasons if you have a slightly longer horizon to be more positive. So, I gave you guys some stocks for the audience hasn't yet heard yet that are all trading below 10 times earnings, and they all have catalysts for improvement. So in the case of Pfizer, besides the activism involved, they're cutting costs and they have a very good pipeline, which isn't being factored yet because as things make it through phase 2 and phase 3 and get into the market, it takes time and there are launch costs and things like that. So we think there's a reasonable scope in the case of Pfizer or in Glaxo, which we can talk about as well, where their earnings are going to accelerate beyond what's the consensus. And because they're so cheap and because they're paying such fat yields, you get a 6.7% dividend from Pfizer, which looks very secure. Similarly, with Glaxo, you're getting a much improved growth profile, getting almost double-digit earnings growth and a sub-10 multiple and a 4+% dividend yield. Those look like extreme values to us in sort of the large cap stocks.
All right. Eric, we got to leave things there on the day, but certainly do appreciate it and want to continue to have this conversation, especially checking in on the performance of some of these picks that you're mentioning as well. Eric, bye, Rich. Thanks so much for taking the time.
As you look towards next year, can it be another year with a Mag 7, some of these really big cap tech stocks with premium valuation? Do you think they can put in another year like they put in this year?
I think they can put in another good year. I wouldn't expect the outsized gains that you made in the last year. Last year, I would have said, this is going to be a pretty critical year for striking a balance between revenue growth and investment. Companies struck that balance, but they also increased the ability to return capital to shareholders. And shareholders got very excited about an initial dividend at Alphabet, an initial dividend at Meta, buyback activity across the sector. Next year is going to be a continued year of investment, a little bit slowing in terms of growth, and investors are going to have to digest that. So I think the risk reward is still good, just maybe not as outsized as when we were here a year ago.
Eric, what about just some of the risks, or do some of these smaller companies that obviously we have seen gain a lot of headway over the past 12 to 24 months, do they pose a risk to some of these larger players?
Yeah, I'm not as much worried about competitive intensity from smaller players into larger players. If anything, some of the key themes in the industry require a lot of capital, a lot of engineering talent, a lot of investment into the businesses. So scale is going to continue to be probably the dominant factor of winning across some of the biggest themes: AI, consumer spending, shifts in behavior online, shifts in behavior from desktop to mobile. So we still have a preference for the larger names over the smaller names. There's a couple of mid-cap names we highlighted in our year-ahead outlook, but still a preference for larger cap over mid-cap.
You look back this year, and two themes within the big cap tech space is regulatory headwinds, and not a lot of these companies were able to buy other companies or do M&A. What do you think the outlook is with the incoming Trump administration? Do the regulatory headwinds ease? Will we see more big deals?
So what we wrote in a note after the election is that we would think it's unlikely the regulatory environment changes. Most of the regulatory oversight or increased attention for the largest technology companies is already in motion. Alphabet faces 2 cases that are ongoing versus the DOJ. Amazon's going to have a case with the FTC. Meta's going to have a case with the FTC. I also wouldn't expect some of the larger companies to be able to do M&A given their current market position in some of their key verticals. Now, they might look outside their key verticals, digital advertising, e-commerce, cloud computing, and try to expand into new areas that way. Maybe that would find more receptivity. But the big getting bigger via M&A and their core competencies, I wouldn't necessarily underwrite that. I do think, coming back to the earlier point, some of the smaller mid-cap names in the sector might want to merge with each other to gain scale. That could be a theme to watch in the year ahead. Private equity continues to be an interested buyer of technology assets. That's another theme to watch in the year ahead.
Eric, let's get to your top pick in the sector, because it caught me by a bit of surprise. We talk about the outperformance of so many of these larger cap tech names. Your top pick for 2025 in the large cap space is Uber. Why Uber?
Well, my team and I are a little bit contrarian. So most of the other names have dramatically outperformed year to date. When we looked at Uber, we see a couple things. Number one, an outsized risk reward. Our fair value is $96. That's dramatically up from where the stock is trading
55%
today.
upside you're looking
Correct.
for? Wow.
With, we believe, not much downside. The stock also has gotten caught up in a lot of debates in the last few months. Number one, the debate around Waymo and what will happen to autonomous vehicles over the next 3, 5, 5, 7, 10 years? How will that impact the way we get from point A to point B? Obviously, some of the moves that Tesla has made, both with respect to autonomous and Tesla's CEO, Elon Musk, and his closeness to the Trump administration. And there's also been a bit of a slowdown in growth because Uber has been lapping some of the pricing dynamics from a year ago. I think we all know that the prices of Ubers are elevated.
$35 for me to get from Penn Station this morning to this office. Like, what's going on, Eric?
So the prices are elevated, but the behavior isn't changing. You're still taking them at elevated prices, so growth is slowing a little bit. So what we always typically look for, especially with our top pick, it was Amazon a year ago, is where is their controversy? Where is their debate? Where can we see outsized estimate revisions and some of these debates getting settled? For us, that's Uber going into 2025.
Is Uber going to cede driverless cabs to Musk? And if so, what's the outlook, not next year, but as you're an analyst, you're modeling out Uber's earnings potential 5 years from now when there might be a couple million of these robo-taxis floating around?
So in our work and in coordinating with the global autos team at Goldman, we believe it is going to be a very long duration cycle before there are enough autonomous vehicles on the road to satiate the demand that are on the streets of Manhattan right now at 10 a.m. Eastern on a Monday. As a result of that, the operators and owners of these vehicles are going to seek yield or return in the interim. And it's much more likely what you're going to see is something akin to the partnership that Waymo has announced with Uber in certain cities, where these vehicles are going to be put into the Uber app. So you're going to be standing on a corner, open up the Uber app, and not only is there going to be the usual choices of different types of supply, but lo and behold, autonomous vehicles are going to be there as well. Because there isn't a human driver, they might be cheaper, but they also might not be as available because there won't be as much supply, so your wait time might be longer. And that's how we think the supply side of this marketplace evolves on the mobility business for Uber.
Eric, getting back to some of your other big picks, you have Google, Amazon, and Meta, you say are among the best positioned buy rating on all of those stocks here heading into the new year. Given what you were just saying before, some of the outperformance that we have seen of these larger cap names, what does that upside maybe more specifically look like?
So Amazon among those three probably has the most upside. We believe Amazon still has exposure to the widest collection of the secular themes you want exposure to in the digital economy. Media consumption habits, shopping, cloud computing, AI. These are all themes you want a lot of exposure to. We also see forward estimates under-modeled for Amazon, especially around profitability. There's been a lot of debate around profitability. The stock became quite mired in that debate in the September-October timeframe, and you've seen the reaction since they got into profitability the way they did in Q4. So still a lot of operating estimate torque for Amazon that we would want exposure to. Plus, to go back to your earlier point about the consumer, Amazon does appear to be an outsized winner in the holiday shopping period from what we track.
You do have some names you don't like, and on your list, you have a sell what on eBay. I get it, like it's eBay. I mean, they sell like auto parts or whatever they're doing. But Airbnb surprised me. What is that a peak travel call?
So what it is the normalization of travel. So our view is that travel benefited dramatically from the summer of 22 through the summer of 24. We all got out of our homes. We all went to Europe. People went to see Taylor Swift in Italy and things like that became very popular. Away from that, we see a normalization to high single-digit growth, but the industry still needs to make a lot of investments. So a growth investment slowing while making investments and somewhat depressing margins, we don't love that setup from a risk-reward standpoint going into 2025.
All right, Eric, always great to have you. Thanks so much for making the time, especially joining us here on set today.
Thank you. Happy holidays.
Wall Street hoping for a Santa Claus rally following a volatile week for markets as investors weigh the path of interest rates next year. Retail investors are feeling bullish on markets for the new year. We want to bring in Brett Kenwell. He's eToro's investment analyst. Brett, it's great to have you here back on Yahoo Finance. Talk to me just about what you're seeing from retail investors. They sound confident that the bull market is going to stay intact. What makes them so confident?
Yeah, and thanks for having me this afternoon to talk about what retail is looking for. I think they remain, optimistic, but maybe realistic as well. When you look at sort of the results, we did a quarterly survey here to see where retail stands, what they expect as we go into 2025. They're looking to gain more exposure to crypto in 2025. They're looking to gain more exposure to equities in 2025, but they're also looking to raise some cash here. And I think, that's pretty prudent when you look across the board and you see how well equities have done, how well crypto assets have done, how well gold has done. You kind of look everywhere, and we've got a lot of nice gains, really not just this year, but over the last 2 years. And to take some of that money off the table and maybe wait for a better opportunity, I think that really makes sense. I think they're being prudent, but also, keeping one foot in at least, is so they keep getting taking advantage of more gains to come in 2025, if that is the case.
And as they keep one foot in there, Brett, what sectors are they bullish on?
Well, you know what? We do this survey every quarter, every couple months, and we get these results back. And the first few times really surprised me to see, what influence financials have had over this group. They really like them, and it's not just, it's not older investors. It's actually a lot of the younger investors. Millennials had the highest exposure to that space. Tech, of course, very close behind. But weighs in at number 2. And when we look at 2025, they said specifically that tech was where they were looking to increase their exposure coming into the new year. So maybe, who knows, maybe tech will take over that top spot next year. But, as it stands, financials have done incredibly well this year. The group's up almost 30%. Retail's exposed to it. They're enjoying the benefits that have come with, having exposure to a sector that's performed well. And when we look at tech, they're looking for big cap tech to carry the trade. They're looking for Magnificent Seven to do well, but they're also looking at AI to do well as well.
Brett, is it Mag 7 that they like within tech, or is it other areas of tech that they're optimistic about?
Yeah, you know what? There's actually some specifics within those spaces. So when we look at Mag 7 specifically, the top rated stock among retailers, the one that they were looking to allocate to the most was Amazon. It was followed pretty closely by Tesla and Apple. When you look at the Magnificent Seven as a group, those three have done really, really well, in particular over these last few months. But since the election, I think it kind of highlights the fact that retail, they can sense an opportunity. They jumped on an opportunity. They've seized the results. Whether they're buying or selling at this point, I'm not sure. But coming into this print is what these were the names that they liked, and so I think they expect those to continue to do well going into 2025. When you look at Mag 7 as a whole, about 60% expect the group to continue to outperform next year. Only 8% of respondents said they expected to underperform. So majority expecting at least inline performance, if not better. And then when you look at AI stocks, only 22% of respondents said that they had exposure to this space, but a majority said that they expect this group to do well next year too. So maybe a little bit of that buy the dip mentality for the names they've missed out on, more specifically in the AI space, could be a play for them in 2025.
What about the election, Brett? Any in your survey work, any trends, themes that popped up there?
Crypto was definitely the most obvious one, or had the highest sort of response where they were looking to gain exposure, and that is not a surprise at all. If you look at the performance of Bitcoin, rallied more than 50% from the election to its all-time high. And referring again specifically for Bitcoin, but when you look at the administration that's coming in there, they have a much more pro-crypto stance. They've been much more vocal about it. So it's not too surprising that investors are looking for this area to gain a little bit more steam. And Bitcoin's done great. There's no arguing how well it's done, not just since the election, but it's doubled in 2024, it doubled in 2023. So this is a space that does have quite a bit of momentum when the trade's working.
Big tech had a big year in 2024, but the regulatory landscape could change significantly. We know as Trump prepares to take office. For more, we're bringing in Daniel Newman, the Futurum Group CEO. Dan, always great to see you. So let's talk about those big tech trends in 2025, Dan. One, we were just talking to Shauna there about chips. So let's stick with that one. And NVIDIA, of course, the face of the AI trade, Dan. Lots of questions. The consensus seems to be, Dan, from the analysts on this show, listen, big cloud giants are going to keep spending to build out AI, and that benefits NVIDIA. Do you see any potential, actual, real, meaningful competition for Jensen Huang at NVIDIA? Or no, his tech, his install base, his developer ecosystem, it's just too strong?
Yeah, this is, first of all, hey, Josh and Shauna, happy holidays. Great to be back. This is definitely a two-sided coin right now. NVIDIA's had an incredible run. Now, the last 6 months, it's somewhat flat, but I shared something over the weekend. I'm like, it's up into triple digits this year, almost multi-triple digits last year. People need to be a little bit patient at times because it has been an incredible story. Having said that, we saw this exuberance and enthusiasm over the last few weeks as Marvell and Broadcom showed earnings. We know that those companies are producing AI chips for the likes of Google, Amazon, Microsoft. We're hearing about Apple's AI chip, OpenAI's AI chip. And that brings a lot of questions. Is this some sort of start of the end for Jensen Huang and NVIDIA? And to that, I say absolutely not. Now, there's two sides, though, going back to that. The first side is NVIDIA's done a remarkable job. It's got 92% plus of the current GPU market, and it has the developers, it has the frameworks, the libraries, it has all the parts on the software side that has made deploying AI possible in such a short period of time. But these giant hyperscale cloud companies, Josh, they're not going to just stand by and give 70 and 80% of the potential margin away for things that they can be the customer zero for. And that's why Google with its TPU, we're seeing Microsoft using its Maya chip for some of its own use cases. Amazon has spent multi-years investing in its Inferentia, now its new Trainium chip. And Apple and OpenAI and ByteDance, they're all following suit. So I think the TAM grows, the generative AI opportunity continues to expand. We roll into agents, but as a whole, NVIDIA will keep growing at a great clip, but we will see new players, and this will mean some competition for Jensen that maybe puts some pressure on them to keep innovating.
Dan, who is the biggest threat?
My take is the hyperscalers are the biggest threat. Now, AMD gives meaningful GPU competition, Shauna, but I think it's the ability for these large companies that have huge install bases to basically redirect spend to their own AI chips. And let me give you a parallel. So about 5 years ago, Amazon started selling its Graviton, which is its ARM-based CPU. Well, today, the data shows that there is about as much AWS on its own Graviton based on ARM as there was Intel-based instances back in 2019. So in 5 years, they've grown to the point where they have a huge deployment because people aren't necessarily calling up and saying, hey, AWS, I want Intel or I want AMD. They're saying, I have a workload. And so as they build software and make it compatible with their new AI chips, there's a possibility that these hyperscalers can do this exact same thing in AI as they've done with CPUs, which has caused, challenges, big challenges for Intel, to a lesser extent AMD.
Dan, let's move to a second theme to watch in 2025, AI agents. Now, Mark Benioff and Salesforce have been making news there, calling out Microsoft, of course. How big is that opportunity, Dan?
Yeah, first of all, we're looking at the overall agentic AI opportunity at something around $4 trillion per year globally over the next 5 years. This is a massive opportunity right now for companies. And the short story is these agents can give you 10, 100, 1,000 people like workers to do things for you, to do tasks for you. The ability to deploy task-based specific agents that create scale, it's a really high efficiency driver for companies. And let's face it, in 2024, we've seen workforces return to 2019 levels, Josh. This is an indicator that the way AI and technology as a whole is being used is super deflationary. Going forward, what we're seeing is now this first iteration of generative AI and now agentic use cases are being used to help drive productivity, but also straight out the gate to create more efficient economics for enterprises. This is going to be a big area, and there's no doubt that the reason that Mark Benioff and Salesforce has run so rapidly in this direction, and not just them, we hear about it from Amazon, from Microsoft, from Google, is that this is where we start to see the combination of smaller models, compliance and safety with AI, private data being in focus, and companies really unlocking the value of their enterprise data to start to create productivity growth. It is in this agentic capability, more so than just language models and audio and video, is where we start to see sales efficiency, marketing outputs, supply chain optimizations. So I'm very optimistic about this particular one, and I think we're going to see it embedded in every software stack. So it's not just Salesforce. You're going to see winners like ServiceNow. You're going to see winners beyond in Microsoft. I like Workday in this particular space, and Oracle are a couple of the names I'm looking at.
Dan, real quick, the third thing that you're watching here is the regulatory backdrop as Trump returns to the White House. Is big tech, are they going to see a break at all from some of the regulatory pressures that we have seen during the Biden administration, even what we saw from Trump under his first term?
Yeah, Shauna, this is going to be a big one. I think a lot of people have heard Trump say he's not a huge fan of big tech. At the same time, he's got these alignments with the likes of Elon Musk and others, which represent the Mag 7. I think Trump ran on this idea of a very prosperous economy, a strong market, and the big seven, Magnificent Seven, weighing on the S&P so heavily. He's got to be very cautious. We know Google has been under some pretty tight scrutiny. We know the App Store has been looked at very, very closely. I think he's going to want to see these companies remain prosperous. But what I do think is we have seen very slow IPO growth. We've seen M&A activity has been hindered. I think if Trump can see the tax rates come down, if interest can in fact fall, we know inflation's been a bit stickier. There is a real possibility that we could see a lot more activity being done, and not some of that activity we saw over the last few years with these sort of pseudo deals and investments around that we've seen, but really these straightforward deals to roll up bigger companies. And of course, the question is, does this make the Mag 7 too powerful? But I think under Trump, I don't think it's going to be slowed down any more than it has been over the last 4 years.
For more on what's ahead for nuclear in 2025, let's welcome in now Mark Nelson, Radiant Energy Group Managing Director. Mark, it's always good to see you and have you on the show. So listen, there was obviously, Mark, and we've talked about this, just a ton of excitement around all things nuclear in 2024. Big, important theme for investors. How do you see, Mark, this theme and trend? How do you see it evolving now over the next 12 months as we head into 2025?
Well, we got to look backwards a little bit to look forwards. 2023 was the year we started hearing some of the tech players behind the scenes thinking about nuclear more. 2024, huge year. It's like the whole world discovered nuclear. The way I'd put it is everything kind of became about AI, and AI became about energy, and suddenly people realized that the tech players did not have a realistic energy growth strategy. They said they were using 100% renewables when they were just going off the grid. Well, they ran out of grid. So what we're looking at now is a 2024 where the biggest banks, a bunch of the world's countries, all made commitments to saying, we love nuclear. That's not the same as building nuclear, and 2025 is going to be the year of show me.
With that in mind, I mean, we've heard a remarkable, and this kind of gets back to what you were saying, we've heard a remarkable amount of companies in the cloud space even talking about nuclear reactors, that they're interested in fast tracking some of their own build out around. What is the timeline that we should be kind of gauging or grading these companies up against when you hear companies like Salesforce or like Oracle talking on their earnings calls about nuclear reactors and how much they're earmarking to invest in that?
I think what's become clear is that the top executives of these companies were sort of blindsided by the energy problem, and they're scrambling to learn as much about energy as quickly as possible. Nuclear is a special form of energy. They're learning about nuclear as they go. One of the difficult things I have to deal with is hearing announcements from companies and attempting to translate that into nuclear reality. What does it mean when it says we have a license to build? So trying to understand that is one of the most difficult parts of my job. What I can tell you, though, is the noise is all in the right direction for those of us who want to build nuclear plants. We just have to be able to respond. I don't think that the tiny reactors are going to be the bulk of the long-term future, and I think I'm backed up by this, by groups like the International Atomic Energy Agency, which sees them as being the small reactors, maybe about 25% of the nuclear market by 2050. What I see, though, is these small reactors helping companies like Oracle explore nuclear at all. Most of America's nuclear plants can power a few million people, but could be doubled in size if we started building more reactors. So what I'm looking for is commitments to build, either the small ones or the large ones, coming through late 2025 and early 2026. That would, to me, indicate that the nuclear fuels stocks, the nuclear supplier stocks would continue to see support like we've seen from this 2024 year of nuclear discovery.
Mark, I'm curious, Trump is moving back into the White House. What does that possibly mean for the industry? What are ripple effects? He wants Chris Wright as his energy secretary, notably does serve on the board of Oklo, Mark.
I've heard nothing but good things about Chris Wright from the energy space. My family is in oil and gas. I grew up in the traditional energy world before switching to nuclear. It's very interesting to see a coming sort of joining between the biggest energy consumers and possibly the biggest traditional energy companies over exploring nuclear. When I see Chris Wright coming in, I see somebody who loves what he's heard from the nuclear story. And his job at the Department of Energy will be to see how he can continue the momentum from, say, the DOE loans office attempting to bring in nuclear players to issue loans to build reactors. I think the big question for me is whether this is going to be a nuclear inclusive story. Is this going to be one of just small experimental reactors, which, don't get me wrong, are very exciting. I'm interested in advising some myself, but also the large traditional reactors whose incredible performance to date in operation, not construction, has led to the possibility of a nuclear boom that we've been seeing.
Mark, what kind of real estate is necessary to bring online more nuclear, and what type of deregulation would that need to be coupled with?
Well, honestly, the real estate play for me has been more about building load, building data centers on farmland around nuclear plants. We've heard of at least one case where a nuclear reactor was possibly going to be restarted, except that the current plans have been interrupted by a rare bumblebee that might be present on that land. So I think that there's going to be some common sense approaches to nation-critical energy supply projects, like turning nuclear plants back on or expanding them if there's a accommodation for the protected species, that I definitely expect to move faster in the new administration. I don't personally see an enormous acceleration from deregulating the reactor technology itself. I think that there's a long history of aggressively exploring nuclear reactors back in the 1950s and 60s, where we discovered which types worked well, which types didn't well. I think we're going to update some of that with some new techniques and some new talent. But the main thing for me is seeing people willing to take the risk of tens of billions of dollars coming together in a consortium approach to put together the users, the sellers, and the reactor vendors all in one package deal to avoid the errors that have plagued nuclear construction in the past.
As you look ahead to 2025, I'm curious, Scott, to get your thoughts there. We have plenty of bulls come on Yahoo Finance, Scott, and they'll say, listen, the economy's growing, earnings are growing, Trump moving into the White House, that means pro-business, pro-growth policies. What's not to like? What do you say to that, Scott?
So I tend to agree and be a little bit more bullish about next year. I believe that the deregulatory movement of this new administration is going to continue to have a very significant impact that reduces the cost of doing business in this country and provides further stimulus for people to bring manufacturing back to the United States. Although I will say that's a trend that has started over the course of the last 18 to 24 months in a more rapid way. That means significantly more investment in some of the real high technology areas that we need to have more of in this country, particularly the types of semiconductor fab facilities that do the most cutting edge types of work. And so that's all a big positive. We've seen the movement of the overall market and the overall economy towards higher technology, much faster growing, better business model types of companies. Those are all the positive things. I think on the side to be wary about is the consumer has been magnificent for a long time now. First, it was all the money that they were given and all the money that they saved during COVID. That's been gone for quite a while. Credit statistics will show you that the consumer is stretched about as much as they ever have been, and default rates are starting to increase. So I think a little wariness is due here, because it's just not generally up forever. Although when one looks at the last 3 years, anyone who's predicted caution has been proven not to be right, at least in the short term. I do think that one of the things that we're going to have to look at is seeing the benefits of all of this technology investment. I think it's going to be there, but I think we may have to be more patient than the market is generally used to. It is not clear yet how immediate the impact is of the tens and what will probably be hundreds of billions of dollars spent to support generative AI. Long term, that's going to have an enormous impact on the productivity of the country and be a net significant positive. Near term, the dollars are being spent well in advance of when we may see some payback, and that may impact the way the market prices companies, at least over the course of the next 12 to 24 months.
Sure.
The last thing I think we need to be wary about is the fact that we have deficits that continue to be at levels that no one could have imagined even 5 years ago, let alone 10 or 20 years ago.
Right.
We have built up our national debt to levels that are way past nose bleeding territory. And we don't yet have any real clear path to solving that problem, though I am encouraged by the fact that you have somebody like Elon Musk who has done really remarkable things in terms of providing services, and particularly if you look at SpaceX, being able to break a cost curve that always seemed to be going up to provide something that we had always thought only the government can provide.
Sure.
So I have some level of optimism there, but I think caution is due, and that caution will manifest itself in interest rate levels that are probably higher than even the Fed wants. I don't think the Fed will have full control over time of interest rates, as we need to refinance 36 to 40 to 50 trillion dollars worth of U.S. government debt.
Scott,
that's a lot in one sentence.
So I want to pick, and I appreciate the detail level and kind of the pillars that you laid out here, the optimism, the pessimism, and then I'll put Musk as his own pillar. We'll come back to that in a hot second here. But as you're thinking about it, and I want to give investors some actionable tips here, as you're thinking about which names those tech investments would prompt you to pile further into, which names come to top of mind for you?
Well, I know there's been some choppiness in NVIDIA recently, but clearly they are the mainstay of everything generative AI, and you're not going to build more capacity to provide advances in generative AI without their technology and without their products. So, that is a name that comes to mind. I think there are real plays in lots of different areas, and you're seeing a lot of investment on the private equity side in companies that help enable the generative AI and all the data processing and all the energy that's needed to occur. So the infrastructure around the sorts of things that will result in the ability to provide cutting-edge generative AI products and services to the market is something to look for and to invest in.
I'm curious, Scott, as you kind of look for opportunities, pull out your shopping list, how do valuations generally look?
Well, valuations have been rich, incredibly rich. So one can look at the growth and the expected growth, but you have to recognize that this is one of the all-time most expensive markets. If you look at the Buffett index, we're kind of in again, triple red territory. And I do respect the fact that Berkshire Hathaway has pulled significant dollars out of the market, hundreds of billions of dollars of stocks that they've cashed in. And I think that reflects some of the valuation metrics that we've seen. If you look at other common metrics, we're somewhere around the 96th percentile of heavy valuation relative to our long-term averages. If you look at just the technical of it, mean reversion is something that you're seeing a lot of investment banking and other strategists and tacticians talk about. And if you believe in mean reversion, for the next 10 years, they're predicting anywhere from 0 to 5% annual increases in the stock market. So it's not that all of the phenomenal things that we're looking at in the market has been unfairly valued from in terms of being valued too low. The question is it being valued reasonably fairly, or is it just really at levels that are going to take a very long time? It's going to take a very long time to grow into.
It's been a great year in the stock markets. And right now we are advising investors at Schultz Asset Management, our clients, to exercise a little bit more caution, maintain some dry powder, and hedge against risk of market volatility like we saw last week, and instead focus a little bit more on short selling opportunities. On the long side, we are advising clients to maintain liquidity, to protect capital during market shocks, also cut losers very quickly, and focus on certain value-oriented investments that have event-driven characteristics.
To what extent do you believe that the unwinding of the Fed's balance sheet could contribute to more market shocks?
To a high extent, actually. I think it's a big number. If you add back the mortgage-backed securities as well as the treasuries that they're selling, and that's taking a lot of liquidity out of the market. However, it's also been telegraphed that they'll probably stop quantitative tightening sometime in maybe the late first quarter, early second quarter of next year. Of course, we'll see how that all evolves with the new Trump administration and how that impacts the overall economy and also just confidence in the markets.
So George, our conversation very focused here on the U.S. and for good reason. I'm just curious, when you talk to clients overseas, George, internationally, are you eyeing any opportunities there?
We tend to focus more on domestic companies, but there are some interesting things that are changing overseas. In China, we are all waiting to see what kind of stimulus the government will release when and if tariff policy really officially takes place. That'll be important to watch whether or not you invest there. Also in Japan, there have been all sorts of structural changes in that economy over the last few years, which is creating some interesting value investment opportunities. In Europe, we're a little more cautious. I mean, there's a lot of uncertainty there. The economy is suffering some of the similar trends that we have here, but they're obviously not, the global powerhouse that the United States is.
George, as you're thinking about one particular name, and we're taking a look at this in your notes, Vistra Energy, of course, one of the largest outperformers over the course of 2024. What type of momentum do you need to see in not just how they perform this year, but the permeation of that into next year to believe that it could still be one of the top players?
This is a great company. Thank you for the question. Yeah, it appears to have been oversold recently. Ticker is VST. And we expect Vistra Energy to rebound going forward as we get more fundamental news. This is a utility holding company. It operates in 20 different states across the nation, selling electricity and also generating electricity in numerous markets. Its predecessor, a company called TXU, restructured in bankruptcy in 2016 after eliminating $40 billion in debt. And separately, in 2012, its Dynegy subsidiary also restructured in bankruptcy after eliminating $4.4 billion in debt. So the company combined has a really clean balance sheet. Earlier this year, it acquired Energy Harbor, which added 4,000 megawatts of nuclear power generation capacity and made Vistra one of the largest zero-carbon generating platforms in the United States. And just regarding the electricity market in general, electricity generation had become a pretty mature industry, but it's growing now because of new electricity demand from data centers and electric vehicles, and also from hyperscalers like Amazon and Microsoft, who are signing new electric supply agreements. So we think there's a lot of upside potential for Vistra. The company is also conservatively run. Its business, its revenues, and its costs are hedged for years going forward, and they just increased their guidance. Lastly, they've been aggressively buying back stock. They had a $5.1 billion capital return program, which has reduced their share count by over 30%. And so going forward, we think there's a lot more opportunity for Vistra.
All right, we're going to continue to track it going into 2025. George, thanks so much for taking the time.
Thank you. Merry Christmas.
Merry Christmas.
Joining us now is Michelle Snyder, Chief Market Strategist at MarketGauge.com. Michelle, good to see you. We got some notes from you saying this is you're focusing on the year of the snake and what that might mean or may not mean for stocks. Break this down for us.
Well, first of all, good morning. Well, it's interesting because I have been following Chinese astrology at the start of every year for a long, long time. And some people might think that that's kind of silly, but there is a great quote by JPMorgan that says, millionaires do not follow astrology, billionaires do. And I think it's because there's a layer out there that we have to be aware of. And I always like to say with 1.7 billion people who follow this in the Asian world, it means something. So the snake actually coming out of dragon could mean more peace, more harmony, prosperity, but it also could mean some volatility. And that's basically what we're keeping our eyes on, with certain signals much more concrete than just following the astrological sign.
What do the spirits of the snake tell us about how people might be investing?
Well, I think basically what it's very, very prosperous potentially for the Asian markets, which makes a lot of sense because they were so beat up over the last year, excuse me, in comparison to what the US market has done. So I think we have to keep our eyes there. I think it also means that if you want to use the metaphor, a snake can coil and hiss and spit, but it can also travel very peacefully. So that's why I think you have to be prepared, particularly with the Fed, how it's set up for next year, a new administration coming in, for some downturns in the market and maybe a rough start to the year, and then possibly by spring, we start to see things level out. It's also very much in line, by the way, with 1965, which was the last time we had this yin wood snake. And that was a year that started out somewhat tumultuously, but ended well with about 3-4% gains. Case-Shiller's kind of there too. So that's kind of what we're looking for as well.
Yeah. Absolutely. Look, most of my dreams or nightmares that have snakes in them are not anything about peaceful travel at all. So I hope that there is some peaceful travel in there aside from the hissing and spitting. You know, as we think about what you mentioned in the new administration coming in, it seems like there has been some hissing, at least pre the inauguration day, and now there's going to be a lot of focus on a few themes, and two of them that jump out to me that I know you're laser focused on as well. One of them you mentioned in deregulation, and the sectors that might be early beneficiaries of that. Financials has really caught a lot of attention there. What's your kind of analysis?
Well, yeah, in terms of deregulation, of course, it's always going to be when and to what degree, and then what, of course, is the aftermath of that. So deregulation sounds great, right? Less government control. But it also means that there has to be some level of oversight. So we know that that can create some issues if the oversight is not necessarily thought out well. So we're looking at that as maybe, at least initially, what people think is, yay, great. But we'll see how much can actually take place as we get into the administration. I think you can look at that in every aspect of what Trump has promised. To what degree, by when, how much friction will they get in return of that? And then, of course, the uncertainty of all of that, what that does to the market.
Michelle, you actually inspired me to check my horoscope in real time. It says I will have a great day and I will talk about stocks from morning to night. So typical day for me. Let's go into some of your picks to that end. I want to lock in on Salesforce, because I just had a chat with Salesforce CEO Mark Benioff, and he was telling me that next year is going to be the year of agents, charging $2 per conversation on millions of agents. I think they're going to rack up some big bucks. Is that your play here?
Well, I love that stock. I've liked it pretty much. Really, it came into my head when I saw the Olympics, because they were one of the big sponsors in July of the Olympics. And then I was watching football yesterday, like everybody else probably. And CRM was Salesforce was a huge part of the sponsor on the Netflix.
Yeah, I saw what was Matthew McConaughey got rained on, right?
Yes, exactly. Yeah. That was a great commercial.
Great commercial.
So, I mean, forget about that. But that obviously what they're showing is they're in the marketplace and they're talking about AI, which, of course, is the great buzzwords of 2023, 2024. And I'm imagining 2025. And so they're really focusing now on increasing AI in terms of how they deliver to customers, marketing, sales. And that means to me that right now, if you look at the chart of that stock, which is pretty hot at around 360, I see no reason why it can't go to 500. Obviously, if the market behaves.
I was surprised to see Rivian on your list, Michelle. And I mention this because, of course, Tesla's really hot. You have basically Elon Musk, second commander-in-chief, however you want to call him. Isn't Elon's connection to this administration bad news for Rivian? And also in the context, Rivian is not making any money, and it's unclear when they will turn profitable.
Yes to both. But however, Rivian does have access to the Tesla charging stations. So it's not necessarily totally in opposition of one another. What I like about Rivian is a couple of things. They had some really good deals this year. The deal with Volkswagen, they got some money to continue to build the plant. They're working on a lower price model. Car and Driver gave them unbelievable reviews. In terms of customer satisfaction, I've read nothing but great comments by people who own Rivians. But the thing is, it's made in America, and that's the thing that really attracts me. In terms of Tesla, cannot be the total monopoly, although it looks that way right now. I think Rivian can benefit. And in terms of turning a profit, well, there were certainly arguments that Tesla didn't turn a profit for years and years while that stock did very well. So a lot of it is going to be the perception, and if EVs aren't quite as challenged as what the administration originally came out with because of Musk.
Michelle, just lastly, while we have you, you have a couple Bitcoin adjacent names that are on your list too, and it caught my attention, especially with regard to Ripple and then also blockchain here. As you're taking a look across the risk appetite that certainly is perhaps best gauged by how many people and what the flows are into Bitcoin, how are you assessing some of the other tertiary plays within the sector?
Well, right, I think that Bitcoin can continue to be somewhat volatile. This 89 to 95 level is kind of really key here. And if that breaks, I think we could see maybe more serious selling. But in terms of XRP, it's an interesting thing because, first of all, you know, it's a cross-border transactional type of situation that is used globally. And of course, here we wound up with the SEC lawsuit with Gary Gensler leaving. It got an initial burst. And even though we haven't started, obviously, with the new administration, I actually think even though the lawsuit's still there, that could be lifted and that could be very good. It's a very efficient system. In terms of blockchain, digital ledger, that's been a lot less volatile. And I think blockchain technology, regardless of what happens with the individual coins, is here to stay, will evolve. And I like that stock where it's been holding over $45, let's say, if we want to be generous with support. So I see upside potential there as well.
Here with more on what to know about investing in tech, we've got Kimberly Forrest, who is the Bokeh Capital Partners founder and chief investment officer. Great to have you here with us this morning, and happy holidays to you. As you think about the trends that could continue to drive the tech trade in 2025, what are some of the bullet points that investors need to keep in mind?
Sure. Well, let me just briefly tell you about me and maybe why you should pay attention to me. I actually was a software engineer that did AI back in the 90s. And whenever I moved into the current industry, I was a sell-side analyst covering software stocks starting in 1999. So I know a thing or two about tech investing and bubbles. And I wouldn't say this is necessarily a bubble, but I think you really have to be careful about just throwing money at the same old places that you did last year, because technology needs different things as it rolls out. And this is going to be a longer rollout than anybody who's currently investing and has won so far is really prepared for, or at least that's my opinion.
A handful of companies that made it through the dot-com bubble and were able to chart their own way to recovery, not only in the share price, but also even furthering the shareholder value, the actual size and scale of their businesses. Some of those are still around for this generative AI era now. What are some of the core characteristics that you see between companies that were able to make it through the dot-com era and those that are able to navigate through successfully this generative AI boom?
I have to tell you, that is the best question I've heard on AI so far. Thank you for that question. So here's what I always look for in technology is what problem are they solving and what price is the solution, and does it merit to be solved by technology. Back in the 90s, technology for AI was unbelievably expensive. We didn't have the data we needed. The machines themselves were, I mean, we spend a lot of money on them, but we have big machines now, right? So we're getting bulk purchasing, not the artisan kind of machines we used then. So I have to, scratch my head and say, are we solving problems with this, or is it just cool? And right now I have to say, the products that I've seen are just cool and not necessarily solving problems, and certainly not at a price that we can afford. JPMorgan did a real quick survey on how much the top 4 companies have spent so far through August. So that's Microsoft, Alphabet, Meta, and Amazon. And it's $142 billion. That is a lot of money. And I don't see a problem that is being solved for that merits that cost.
So how can investors then grade the spends versus the timeline for it to come to fruition and the return on that investment?
Sure. Well, pace yourself. And understand that the technology is going to mutate a little. Right now, NVIDIA is the big winner, and they have a GPU chip. But it seems like Broadcom has a solution for another part of the problem, which is inference. So maybe you want to look for companies like Marvell and Broadcom that are adding to the solution, right? So you want to do that. And I wouldn't kick NVIDIA to the curb. You know, they are still doing very well, and their product is needed. It's just that you may lose momentum investors there as people have other choices and other directions that the spending is going to go in. So right now, NVIDIA really moved higher because it was a momentum investor's darling, but also because the underlying product is very necessary for the next generation of computing.
Kimberly, really actionable advice and valuable insights for our viewers. Appreciate it. Thank you.
With us now is Mike Dixon, Horizon Investment Head of Research and Quantitative Strategies. Mike, good to see you. You see a broadening out in markets. What's behind that call?
Yeah, when we look at what's happened this year with just the mega cap indices, there's just been an enormous divergence between the top of the market and the average stock. You know, common index to look at there is the equal weight index. When we look back to last year, we saw the same thing. So we're putting together two back-to-back years of some of the most dismal performance for the average stock relative to the market cap weighted indices. I mean, it even rivals back what happened in 1998 and 1999. And so as we look into next year, I think that large valuation gap and that performance divergence really sets up well for some catalysts to be able to drive that spread more closer and actually see the broadening out in the market that I think we've all been waiting for a while.
And so what are the areas of the market that are most apt or primed to see that broadening out occur for them first?
Yeah, I mean, a space I really like is the small and mid-cap stocks. And when you look at the month of December, it's actually been quite terrible for the Russell 2000, especially compared to the top end of the market. And, of course, we have Trump taking office here in a couple weeks. And when you look back to 2016, at this point, 6-7 weeks out from the election, small caps are up 16-17%. At this point, we're actually completely flat here in 2024 on that measure. And so I think a lot of the policies that the Trump administration is going to put in place from a deregulatory perspective, you should see a similar playbook to what happened in 2016. I think makes a really good setup right now as kind of an entry point, given the weakness we've seen in the month of December as we head into next year.
Mike, we've been talking about the Yahoo Finance chart of the day all morning long, really looking at how much or how large the top 10 stocks in the S&P 500 have grown as a percentage of the index, now almost 38%. Is it time to go underweight some of these big names like an Apple, an NVIDIA, Amazon? Underweight would be the equivalent of in my case, a sell. These stocks can't go up in a straight line again next year, can they?
I mean, you wouldn't think so, and you're right. I mean, we were sitting back here. I remember sitting back here in 2019 when the top 10 stocks made up roughly 20% of the market, and just thinking just how extraordinary that was. And here we are, 5 years later, roughly double that. I think there are a lot of opportunities, and we have some excellent catalysts in place as we head into the new year, particularly with the AI theme. That doesn't have to just mean the top of the market. Has to go higher, because when you look back the last 6 months, I didn't believe it till I saw the chart. Broad semiconductors and NVIDIA are roughly flat over the last 6 months. But you've seen some of the phase 2 recipients. I think Broadcom just a couple weeks ago, their earnings report, an excellent example of this. They have that VMware integration, bringing software and services to the masses, and saw an excellent response with their earnings call just a couple weeks ago. You saw the same thing with Salesforce about 3 weeks ago as well. And so I think you're starting to see, some of the phase 1 recipients kind of being just the hardware side of semis to the phase 2 software and services, which, means in the tech space and in the AI, enabled space that you can begin to get exposure with some of the smaller companies in that space and move away from just the very top end of the market. I think that's a very warranted and good view heading into next year.
Even as we think about the different plays within AI and where we've seen the energy play, where we've seen the chips play, of course, which has held strong for so long, and we almost kind of need an updated "you are here" type of mall map in that AI trade. as we're thinking about the next area that's set to be a beneficiary, it seems like there's been more focus on the LLMs and the models, and then the applications that can sit on top of those as a more futuristic trade here. Who are some of those top names within the models that you think are starting to really be elucidated by traders?
Yeah, when you look at kind of the where we are picture, I think we are between first and second base at this point. Given some of those numbers I just referenced, I do think you have started to see a pretty firm transition away from just NVIDIA, just semiconductors. I just mentioned Broadcom as a great example of that. It's still a hardware company, but software and services is where a lot of their positive commentary came around from their earnings calls. But you do have to be very selective. I'm going to give you a couple other examples that didn't work out too well, and that was Adobe and Oracle. We just saw those a couple weeks ago. Those stocks did not respond very well to their guidance, and I think the main reason there is some of the way that they're bringing AI to the masses. It's not a super unique offering, right? So with Adobe, you can kind of embed that AI in their software, but it doesn't really move the needle as much as something like Broadcom is doing. So you do have to be very selective amongst those names. You've seen other ones like Palantir as a great example that's been able to capitalize on this kind of software and services movement. But even if you are just going broad sector level, I think going inside of tech to a software and services is definitely kind of that phase two, and what's going to take us to go from in between first and second base to rounding third.